Bond investors have something to say, even if the Fed doesn't really want to hear it. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking you off to closing bell here in the U.S., and it's another quiet day in the equity market, though we are looking at some gains on, I believe it's Wednesday. You take a look at the S&P 500 up by 0.2%. It's a similar story if you take a look at big tech as well. The NASDAQ 100 also up by about 0.2%. So pretty small moves there, but then you take a look at the bond market, and holy moly, you can see that bond market rally continuing here. 10-year yields below 430, down another 5 basis points today. It's going to be interesting to see how low they can go. And I did want to highlight crude, Romaine. Of course, we've been talking about crude falling for weeks now. You are seeing a little bit of life come back into the energy market right now. Crude up by about 1.7%.
Yeah, another strong week potentially here for crude oil after coming off of those big losses. Also another strong week for that global bond rally, which has really been shifting into higher gear this week. The steepening of the U.S. Treasury yield curve supported today on this Wednesday by multiple block trades we saw this morning that only really pay off if the Fed does indeed flip to rate cuts sometime soon. But the folks who see that payoff coming are growing in number. CFTC data released on Monday showed hedge funds increased to an all-time high their net long positions in futures on that secured overnight financing rate that tracks what most folks think the Fed might do next. That payoff, though, of course, will be determined not by the market, but by the 12 voting members on the FOMC, which starting in January will include Atlanta Fed President Raphael Bostic and his Richmond counterpart Tom Barkin. Both spoke today, but gave divergent views on the path of U.S. inflation, with Bostic writing about his growing confidence that inflation is firmly on a downward path, while Barkin wanting that optionality to hike again. Traders positioning towards that dovish narrative, with the bond market pricing in a quarter-point rate cut by May. But billionaire investor Bill Ackman says he's putting his money down on a rate cut coming even sooner.
We have another one on as we speak. Actually, we're betting that the Federal Reserve is going to have to cut rates more quickly than people expect. That's the current macro bet that we have on.
Bill Ackman speaking there, Katie, and we're going to spend a lot of time today talking about the state of the U.S. economy, given the economic data we got this morning, which includes upward revisions to third quarter GDP and downward revisions to personal consumption.
Well, let's start with GDP, because a really shocking print here for the third quarter. Remember, the initial print was for 4.9%, which already would have been quite surprising. That was revised in an upward manner, as Romaine mentioned, 5.2% growth in the third quarter. That is the strongest pace in about 2 years or so. And you can see it's a real shift from what we've been seeing in terms of the growth that had been, again, growing, but not exactly to the tune of 5.2%. So you take a look at how markets are reacting, and it's like Romaine mentioned, you're seeing a rate cut from the Fed priced in as soon as May, about 29 basis points priced in, so a little bit more than a quarter point cut priced in. So investors clearly say not only is the Fed done when it comes to rate hikes, but that cut is going to start coming sooner than the Fed is expecting, maybe not as soon as Bill Ackman says, though, Romaine.
All right, that's a look at some of the hard data, the anecdotal data now coming out as well. The Fed releasing its Beige Book. Bloomberg's Michael McKee standing by with a readout on what we learned. Mike.
Yeah, Romaine, that was third quarter data we got this morning. The most recent data, that was then, this is now, from October and November. At least the anecdotal reports are that growth is slowing. According to the Beige Book, just out from the Federal Reserve, on balance, economic activity slowed since the previous report. 4 districts report modest growth, 2 indicate conditions were flat to slightly down, and 6 noting slight declines in activity. Retail sales, including autos, remained mixed, it says. Demand for labor continues to ease, according to the Beige Book, as most districts report flat to modest increases in overall employment. There are more people available, more applicants to take jobs, and several districts noted that retention improved as well. But, and here's something we have not seen before, reductions in headcounts through layoffs or attrition were reported, and some employers felt comfortable letting go low performers. That's definitely a change in the way the labor market is being portrayed. And finally, prices increases are largely moderating across districts, though they remain elevated.
I am curious. I know we sort of dismiss sometimes some of the stuff in the Beige Book, that it's very anecdotal, it's very backwards looking, but this is the last Beige Book where I believe we're going to get this year. And I'm curious as to whether this changes at all or could potentially change the conversation when they head into that meeting in a couple of weeks.
Probably not, because basically this is ratifying what we've heard from the Fed officials today. And you look at the speeches from Tom Barkin and from Raphael Bostic, even Loretta Mester, they're talking about what they're hearing from officials in their district, from CEOs in their districts, and that's matching up with what's coming in the national summary here, that the economy is slowing, not a recession, but things are slowing down and price increases are moderating.
I want to talk a little bit about what we learned about the consumer in this report. Consumers showed more price sensitivity, according to the Beige Book. Also, that consumer spending on discretionary items declined. And this is interesting because in addition to the very strong labor market, we keep talking about how the consumer is miserable, but they're still spending. Maybe a little bit of a trend shift here as well.
Well, even in the third quarter numbers that we got this morning in GDP, it showed a lower than previously reported consumer spending level. So it is possible that consumers are slowing down and the overall economy seems to be slowing down. The question is, how slow is slow? 3.4% was the third quarter GDP consumer spending number. That's still very strong. We have to see how the holiday season turns out. The Beige Book is looking at data up through November 17th, so it's not even in the week of Black Friday. And I'm sure, Katie, you were out busily snapping up deals.
I was actually here with Romaine talking about it.
It was glorious.
It was a lot of fun.
I'm sure it was a lot of fun. But we'll find out whether consumers are still wanting to spend or not as the next weeks go along.
All right, Michael McKee, our Bloomberg International Economics correspondent, breaking down the latest information that we're getting out of the Fed. That Beige Book, a bit backward looking, but you combine that with some of the Fed speak that we've gotten over the course of this week, as well as the hard data, and maybe there is a picture being painted here of economic conditions that the market can actually take to heart. Ellen Zentner joining us right now, the chief U.S. economist over at Morgan Stanley, and that is where I want to start, Ellen, as to what picture right now do you think is being painted?
Well, same as what we've been expecting in the outlook, right? The economy is slowing, but not falling off a cliff. And this Beige Book basically is very similar to the one for just the prior meeting, right? Consumers do not have unlimited price tolerance. Companies are finding it harder to pass on price increases. The economy is holding up but slowing. Credit availability is slowing. These are hallmarks of a cycle that's moving into a slower gear. And I think, as Mike said, right, ratifies what we've been hearing from policymakers. It also tells you why they're very comfortable holding steady here and not raising rates further this year.
This gets to the question, though, too. I mean, when we talk about some of the disinflation that we have seen, where exactly that disinflation is showing up and why it hasn't had a much broader impact on the headline numbers that the Fed wants to see come back down to 2%.
Well, that last comment, that's where I would disagree a little bit. I mean, I think the Fed has seen inflation decelerating a good deal faster than they had expected. But they are not going to declare victory too early. We've heard that also from Christine Lagarde at the ECB. This is when you've had egg on your face so many times about inflation, and I'm not just saying that about policymakers. I'm talking about economists in general this cycle. You do not want to declare victory too early, but it is very encouraging that it has been coming down quickly. And I want to tie it back to consumer demand. So what we're seeing here play out in the data is that there is nothing that has changed cyclically in the way inflation develops. Households start to trade down. They go for cheaper goods, cheaper alternatives, and that changes the weights in those categories in inflation indices, and that has a gravitational pull on inflation overall. And so we're seeing this play out right in front of our eyes, that all of the assumptions that maybe the world has shifted in some way in terms of inflation, no, inflation is still developing just the way it always has over the cycle. We just had to hit this point where consumers have said, enough, you're not passing on price increases to me anymore.
And again, looking through some of the headlines of this Beige Book, a suggestion that maybe we're there when you think about the more price sensitivity that consumers are showing. But Ellen, I want to talk a little bit about the labor market here. As Mike McKee highlighted for us in the Beige Book, demand for labor continued to ease, and that the majority of districts reported that there were more applicants available than maybe in prior periods. How are you thinking about the labor market here? And are we finally reaching the point where the edge comes off?
Well, the edge should come off, yes, but again, it's a very similar story to the consumer, right? Slowing but not falling off a cliff. So jobless claims have remained very low, so we know companies are not laying off broadly. But if you look at continuing claims, people are not getting reemployed as quickly. So there is more slack building in the labor market. I love hearing that there are increased applications. This you can see in the participation numbers, which have been going up. And this is why Chair Powell in the FOMC can seemingly brush off a 300,000 plus payroll print by saying, hey, this is great. It shows more supply coming into the labor market and a better balanced labor market. And why, when the unemployment rate is rising, it's rising for the so-called good reasons, more participation. So we're not out of the woods yet in terms of really strong jobs prints. I think we get another really strong one in this print coming up. But we do see the makings of slower labor market, slower job gains. And again, that is also what's underpinning slower consumer spending going forward, because labor income has been slowing down.
And Ellen, when you add this all together, the data that we've been getting, also the Fed speak that we've been getting, and you compare that to what the market is pricing in, a full quarter point cut priced in by May, is that a realistic timeline to you?
So it doesn't look to me like that is sort of an outsized market expectation. If you were to tell me the market was pricing in certainty of a start to cutting in March, I would say the market has taken that a bit too far. But my own view is that they start cutting in June and they cut 4 times next year. And I have a much faster pace of cutting through my outlook than others, right? So they start cutting every meeting by the fourth quarter of next year, and they're cutting every meeting in 2025. And right now, it just simply comes down to a difference of opinion about the outlook. How quickly do you think inflation will fall? And this is exactly what the Fed is grappling with.
One thing that, though, I'm trying to wrap my head around, if we do get into a rate cut environment, is kind of where do we end? Because there was so much talk about higher for longer, the idea that even if the Fed doesn't raise again, that we're going to be camped out somewhere in the 5% range on the Fed funds rate. Once you start factoring in rate cuts, that, of course, changes what that baseline ends up being. Do you have a sense of where you think that might actually be?
Yeah, so this is going to be the tough part for market participants this time. I think about all of the risk takers in various firms that are not old enough to have practiced through an environment where you know anything but the zero lower bound in a downturn or in an easing cycle, right? You know exactly what to do because the Fed always just simply cuts rates to zero. We are not revisiting the zero lower bound, which means the Fed can cut in a cutting cycle, and maybe they cut to 3% funds rate. Maybe they do cut to just 2.5% funds rate, but certainly well above zero. And I think that's something that the investors are going to have to really get used to in this cycle.
And Ellen, like you said, you definitely have a faster pace of rate cuts penciled in than most on Wall Street. What is the catalyst of that and the driving force? Is that just the Fed getting back to normal, back to neutral, wherever that is, or do you see a recession or a downturn in the offing?
So we continue to see a soft landing. That's a view that we've had since March of 2022, and that still seems the appropriate outlook to have. So we have a normalizing policy cycle. So the Fed, when it starts cutting rates, which we again expect to start in June, it's not going to be easing policy. It's going to be reducing the level of restrictiveness. And you're going to hear this from Chair Powell. Maybe we hear it from him in prepared remarks on Friday, if he does deliver some prepared remarks before he sits down for that fireside chat, right? This is about you want to keep real rates high or a certain level of restrictiveness, but you don't need to be as restrictive over time as inflation is coming down. So you're marching rates lower in line with falling inflation. To the Fed, that's not easing. Right? That is just becoming less restrictive.
Yeah, well said. Ellen, always great to talk to you. Ellen Zentner, one of the best in the business out there over at Morgan Stanley, the chief U.S. economist, helping kick things off to the close here on this Wednesday afternoon, a day where we got some big news here, a report that Cigna and Humana are in talks to merge and what it would mean for the health insurance industry.
Plus, part of our conversation with General Motors Chair and CEO Mary Barra, her outlook for the automaker's growth and when it will have affordable electric vehicles.
And we're going to have a conversation with the Our Crowd founder and CEO John Medved, his insight on the state of the Israeli economy as that country lowers its growth outlook. That conversation and so much more coming up in a bit. This is The Close on Bloomberg. Given where we are in the Fed tightening cycle, we know that members of the FOMC are less dependent on the economic data, the hard data, and a little bit more dependent on some of the anecdotes coming out of the various Federal Reserve banks. The Beige Book just dropped, and it does show that U.S. consumers are pulling back on discretionary spending. Katie Nixon, Northern Trust Wealth Management Chief Investment Officer, is joining us right now to talk a little bit more about where we stand here in the state of the economy and, more importantly, how investors position around it. And I want to start off here, Katie, with something that jumped out at me in the Beige Book, and it's something that is somewhat familiar. Sales of discretionary items and durable goods like furniture and appliances declined on average as consumers showed more price sensitivity. That seems to be a narrative that we've heard time and time again over the past few weeks and months.
Absolutely, Romaine. Well, we've seen sort of at the margin things changing quite a bit over the last several weeks and months as consumers have started to dial down their spending. They've certainly dipped into their savings. Now they're being much more discerning about what they're spending money on. And we heard this from some of the retailers as well. There's much more price sensitivity and generally a slowing of demand in those discretionary areas that had really buoyed the economy post-COVID.
Do you think, just in talking to your own clients as well as your peers out there, is there a disconnect between the health of the economy and the way that people actually feel about the economy?
I don't think so, Romaine. I think people are still really smarting from the inflationary pressures that we've all been feeling over the last several years. And I know as strategists and economists and asset allocators, we focus on inflation as the change, which is obviously the definition of inflation. But for real people, for households, for consumers, inflation is the level. And although we have inflation slowing, the prices are still really, really high. So I think that is why you see this sort of disconnect between the economic data and when you look at the survey data, the UMich survey data, for example, which shows that sentiment is not as ebullient as you would expect, and people are still nervous about inflation.
Katie, I think that's a great point. It's something we've been talking about on this show, that with inflation, it's not just the rate of change, also the absolute level is what matters. And given that you are starting to see some consumer pullback, it seems like that pricing power that companies have really enjoyed is starting to ebb here. What does that mean for the equity market going into 2024, now that we might actually be approaching that tipping point?
Well, Katie, there's two elements to next year in terms of earnings. One is revenues, and then there's margins. So on the revenue side, revenues are measured in nominal terms. So higher inflation has actually helped revenues. With inflation turning down as we enter into 2024, and with consumption drivers turning down, the outlook for revenues is a bit dampened, I would say. So both of those things are headwinds. And then you come to the margins, and I think you covered it well. Companies are just having a tough time passing on price increases to customers right now. So you're starting to hear that more and more from manufacturers, from retailers. So I anticipate that what is baked into the market now in terms of margin expansion might be overly optimistic.
Might be overly optimistic. Is that really a broad brushstroke sort of view here? Are there any industries, are there any sectors that are positioned maybe a little bit better than some of their peers here?
Well, one of the pieces of good news, I think, is that we are seeing disinflation in certain areas of the economy and in the market that will benefit companies. For example, we have energy prices that are coming down. That's obviously going to help at the headline level, but that's also going to leach through to corporate earnings as their energy bills are lower and lower. And then we heard about some disinflation coming out of the retailers as well. So it's not a black and white issue. I think there are nuances, as you point out, that might benefit certain industries and might be headwinds to others.
This gets to a broader question, too, I guess kind of looking a little bit more long-term, Katie, about all that we've gone through. Kind of you start back in 2020 with the pandemic and all of the issues that sort of fed into the market gyrations leading up to today. And the big question really is, the result of that, are we going to be looking at a completely different landscape, an investment landscape, an economic landscape, or are we going to maybe revert to the mean, if you will, for lack of a better term?
Romaine, I am never a fan of saying it's different this time. So I'm going to say it's probably going to be a variation of the themes that we've been living through various market cycles. And I loved what your prior guest said about, in some ways, this sort of all playing out according to plan. These things are happening in a sequence that, while maybe some of us who have been in the market for a long time are familiar with, others who might not be as as tenured, might be less experienced with. We've been through these ebbs and flows of cycles. I think we're going through another one. I don't think it's necessarily going to be markedly different than prior periods. The one thing I will say, though, that I think Ellen Zentner was getting at is in a higher for longer environment where we are not going to go outside of a crisis back to zero interest rates. What does that mean? That means that investors are going to allocate capital perhaps a little bit differently, right? When capital is actually expensive, it means that you're not apt to misallocate the way that you were when money was free, frankly. So it means that investments are going to be done, I think, with a more eyes wide open approach, which is ultimately much more healthy.
Well, from one Katie to another, really enjoyed this conversation. Our thanks to Katie Nixon.
Which one is your favorite, Katie?
That's a hard question to answer. I won't do it on live television. Katie Nixon of Northern Trust Wealth Management, thank you. Coming up on The Close, part of our conversation with General Motors Chair and CEO Mary Barra about when GM will have affordable EVs for sale. That's next. This is The Close on Bloomberg.
We think we're going to see a strong adoption for our products. And as the charging infrastructure continues to be more robust, we think that's going to drive adoption as well as having affordable EVs. And that's where when you look at the Chevrolet Equinox as well as the Blazer and the Bolt that's coming, we're going to be having products in that range of affordable vehicles that is going to be very important from EV adoption.
All right, the head of General Motors, speaking a little bit earlier there on Bloomberg, and it's interesting, too, talking about, Katie, some of the issues that they're having in that EV push. But we should point out the stock right now having its best day since early 2020. And that's largely because she's basically saying, look, we're going to boost our buyback program, $10 billion,
yeah.
to boost our dividend. And she's basically promised them some modicum of profitability, but not necessarily from the EV business.
Yeah, and it's interesting, again, to boil it all together and still the stock having such a banner day. But I guess that's what happens when you do announce such a big buyback plan. I thought it was interesting to see that buyback plan come through just after they inked that deal with the UAW, because that was one of Sean Fain's talking points, basically criticizing GM for, buying back shares over the past decade, and here we are. Yeah,
that's a good point. I didn't really think about that. I do kind of feel, though, it's a little bit of a master stroke on her part, because, I mean, the EV side of this, is really struggling, and at least it hasn't proven to be as lucrative as maybe people thought it would. So this actually, I guess, maybe buys her a little time, right? I mean, investors are going to be happy with the buyback and the dividend increase, and maybe they'll take some heat off her on the EV side for at least maybe a year or two. Yeah, you remember shares were down 14% through yesterday's close. No longer. This is The Close on Bloomberg. This is the countdown to the close, just about 2:30 here in New York. A bit of an everything rally here on this Wednesday afternoon. Modest gains in the equity space, modest gains on the price level for treasuries, and, well, additional gains today when it comes to crude oil. Abigail Doolittle is standing by right now with our Commodities Close. Abigail.
Indeed, we're looking at impressive gains for crude oil, Romaine. WTI crude up 1.9%, up another day after a bit of a losing streak. In fact, into this week, I believe down 4 weeks in a row, back below $80 per barrel, where it's been for a little while. But of course, we have that OPEC Plus meeting tomorrow, so some traders betting that maybe the production cuts that Saudi Arabia has been lobbying for, well, maybe they'll happen. Natural gas down 1.2% despite the cold weather here in New York. European natural gas down dramatically, down 5%, so a bit of a sympathy trade there, and the reason being the expectation of weaker demand on the possibility of a warmer winter in Europe. Heating oil futures down about 0.8%. Wheat rallying for a second day, up 2.5%, and this has something to do with tighter supplies and improving demand relative to those supplies. There have been harvest delays in Australia, and there are also export restrictions in Russia boosting those prices. As for oil, we have had this big breakdown that we've looked at in this chart, this topping pattern, and right now we're in this clear consolidation pattern. The 50-day moving averages rounding down. This range will break probably $8 to $10 to the upside or the downside. The signals are more likely to the downside, perhaps towards 65. Seems like some volatility could be ahead for oil, Ramin.
All right, Abigail Doolittle with a nice wrap up there of what's been going on in the commodity space. And today's actually been a relatively big day for deals. And just about 2.5 hours ago, we learned that Cigna and Humana, two of the biggest health insurers here in the United States, are in talks about a potential combination. That's according to people familiar with the matter who spoke to our reporters here at Bloomberg. Joining us right now to talk a little bit more about this is one of those reporters, John Tazi. And John, let's start off here with what everyone really wants to know, and that, quite frankly, is this a deal that can actually get past regulators? Because I haven't seen a major healthcare deal of this size actually make it through the gauntlet in several years.
Yeah, that's a great question, Romaine, and I think that's what investors are asking too. I mean, we see both stocks down pretty significantly on this news. I think that may be an indication that the market is, a little skeptical about, whether something like this could clear antitrust scrutiny. As you know, there have been two other horizontal deals in the space were blocked, a number of years ago. One of those involved Cigna and Anthem trying to combine, and the other involved Humana and Aetna trying to combine. So there was a sense after that sort of horizontal combination in health insurance was kind of, that there wasn't room for another mega deal.
Well, and it's interesting, too. In the Bloomberg reporting, we actually cite the CFO who was speaking at a conference earlier this month, who basically alluded to this idea that any proposed mergers would have to have a high probability of closing. That's the quote there. I would assume, maybe I'm being presumptuous here, that they would have had some pretty significant confidence to even move down the road in these talks.
Yeah, I mean, that's been Cigna's position for a number of years now. I believe that they have kind of said that, among other things, deals, have to have a high probability of closing. The one thing that might sort of assuage some of the antitrust concerns in this case is that in some ways, these companies are not competitors in their main lines of business. Humana is primarily focused on Medicare Advantage. Those are health plans primarily for seniors. Now, Cigna is in that business, but it's a small part of their business. Cigna is much more focused on insurance for big employers and individuals, and on pharmacy benefits. Now, that's an area that Humana also has some assets. So, there's definitely some overlap, and this is the kind of combination that I think would face a lot of antitrust scrutiny and, frankly, political attention. But you could see the companies making a case that they are more complementary than overlapping. Whether that clears the hurdle, I don't know.
Well, John, what's interesting to me is you take a look at the market reaction right now. It's kind of a wipeout in both stocks. Cigna currently down about 7.8%. You take a look at Humana down about 5% at the moment. Usually in these types of situations, you see the target go up and the buyer go down. But in this case, is it fair to call this a merger of equals potentially?
Yeah, I mean, I think we don't know what the contours of any potential deal might look like, in terms of, so yes, I think it's, in some ways it could look like a merger of equals, but yes, clearly Wall Street doesn't seem to, the market isn't receiving this deal very well, clearly.
Yeah. Well, John, got to leave it there. Really appreciate your time and your reporting. Our thanks to Bloomberg's John Tazi. Now, still ahead, security software firm Snowflake reports after the bell. We'll talk about how the company's new partnerships could boost its platform. That's next. This is The Close on Bloomberg.
All right, let's get a view from the sell side with our top calls, the big movers on the back of analyst recommendations. And we start off with Hershey. The chocolate and candy maker downgraded to neutral over at Piper Sandler, with the analysts worried about cocoa prices that have surged 70% so far this year. About 12 to 15% of the stuff that Hershey sells comes from cocoa, and those supply shortages are expected to drive cocoa prices higher, according to the analyst. Shares of Hershey lower on the day. Next up, let's take a look at Petco. in the doghouse after reporting weak third quarter results. Wells Fargo cutting to equal weight and lowering its price target down to $3 from $7. The analyst citing concerns over consumer discretionary headwinds and low visibility as to what comes next. An awful day here for Petco. Wolf, 30% lower. And finally, Okta. Third quarter results are out. They were better than expected, but Piper Sandler just couldn't grasp the far-reaching nature of that data breach we learned about just a few weeks ago. It dropped its rating to neutral, and the analyst says Okta's 2025 growth outlook is well below what the street has in mind, and he wouldn't be surprised by some investor hesitation there. You can see that hesitation reflected on the screen. The share's down 3% on the day, and those are some of our top calls. We do want to stay in the sell-side space and stay in the security software space. We're expected to get results after the bell tonight from Snowflake. Joining us right now, Brent Thill, equity research analyst over at Jefferies. He has a buy rating on the shares. And Brent, let's get right to it. We've had a few of Snowflake's peers have already reported. Was there anything we learned from those reports that we're going to see later tonight?
Yeah, I think the peers for Microsoft and Amazon are a direct reflection of what's happening in consumption. Demand trends are coming back. I'm at the Las Vegas conference for Amazon, and you're hearing customers say, demand and spend comes back after these optimization headwinds. Given that Snowflake's model is one that's based on usage, we think that Microsoft and Amazon are good proxies for what's to come. The comps are getting easier, and the model for the numbers, we're at one of the lowest sequential growths we've had for quite some time versus historic average. So we believe the setup is looking better. The biggest concern for Snowflake is it trades at one of the highest multiples in software. It's one of the premium franchises run by the premium management team. But again, valuation is our biggest concern headed into the print.
Yeah, Brent, that's what I want to talk about a little bit more. You mentioned that premium that they're trading at. In your view, it seems like that's justified, but how high does that raise the bar heading into tonight's earnings?
Yeah, the bar is up. If you look at Workday, Intuit, a number of software companies have had good reports. We've seen a real divergence. Some of the small and mid-cap names have had not great prints, and those stocks have gone down pretty big. But the leaders, such as Intuit, Adobe, Microsoft, have been really solid, and we put Snowflake in the leader quadrant in their respective category around the data cloud. So we believe the bar is high. It's not extremely, it's clearable, and certainly, again, the demand trends are looking better as we head into the seasonally strong fourth quarter for what we're seeing right now.
And Brent, what are you expecting to see when it comes to Snowflake's customers and who's actually spending? I know that there was commentary earlier in the year from some of the management over at Snowflake that they're seeing a lot of activity among their largest customers. Do you think that that is necessarily representative of what's going on at their broader base, though?
Yeah, I mean, they're tied to the largest enterprises in the world that are putting their data in the Snowflake cloud. So I think what the customers are going to say is matching with what we're seeing. Again, and a lot of the trends we're seeing is demand starting to come back. Comps are getting easier. Headwinds are becoming abating. Again, remember, AI is a big driver, artificial intelligence for Snowflake going forward. So this ability to put your data in Snow and then ask simple questions. How are my sales this month versus last month or year over year? How have my top customer changed? Those initiatives around AI, we think Snowflake can bring AI to the mass market, and adding these simple queries on top of their platform is an incredible value proposition. We think it has yet to come out and should potentially help accelerate growth and backlog. So if they can continue to put up north of 25+% backlog growth and continue to point to close to 30% growth, we think that the stock will get support from here.
All right, Brent, always great to talk to you. Going to be a busy day later tonight. Brent Thill over at Jefferies, taking a closer look at Snowflake's. Katie, those earnings expected to cross the wire a little bit later tonight. And we should point out there are quite a few other folks in the software space that are also going to be reporting, and that includes a big one, which is Salesforce as well.
Yeah, earnings season far from over here, and it's going to be interesting to see the reaction to Snowflake, as Brent was talking about. Of course, it trades at a very high multiple. The bar is high. We'll see if they can deliver.
And I remember we were talking, I don't know if it was Mandeep Singh over at BI or a couple of people, were kind of talking about this idea of consolidation and whether you need to see some of these standalone, particularly in the cybersecurity realm, some of those names get absorbed into some of the larger companies. Is there real viability to be a standalone company at a time when a lot of enterprise customers really want to reduce the number of vendors?
I like their names, though. Snowflake, Datadog, we need more names like that, I would say.
Do you really? Is that the marketing?
Snowdog, maybe they could do something there. I don't know.
Well, we have some other ones coming. We have Five Below. That's a cool name.
That's
not a software company.
No, not exactly. I don't think they have much to do with the cloud.
Synopsys.
But,
PVH. You remember that?
No.
Okay.
All right.
Well, I think we're done, Katie.
I think so, too.
Coming up, we're going to have a more serious conversation in just a bit here. The situation in Israel, of course, still has not been resolved. And there are a lot of focus on the humanitarian efforts, but also a big focus on the Israeli economy. John Medved, Our Crowd founder and CEO, is going to be stopping by to talk about the economic effects of the war in Israel after the break. This is Bloomberg. Welcome back to The Close. It's time now for our Wall Street Week daily segment. The host of Wall Street Week, David Weston, joins us as he does every day at this time. And David, we've been taking, of course, a very close look at the humanitarian toll of the war in Israel against Hamas. At some point, though, we have to start talking about the economic toll as well. And more importantly, how you, get the economy back up to where it was prior to the incursion by Hamas.
As you say, humanitarian really takes precedence, but there is a substantial economic aspect to it as well. And so we check in from time to time with a man named John Medved. He's Our Crowd founder and CEO. He's the leading venture capitalist in Israel, really part of the startup nation. So we talked to him and we asked him about what is the effect. Now we're 7 weeks into this war. What's the effect in Israel?
There's a pattern which repeats itself every time we go to war. And that is in the first couple of days, markets go down, the shekel goes down, investors are spooked. And that's all completely natural. But then as the war starts to develop, people start to relax. They begin to realize that the world is not coming to an end. And everything starts going back to normal, more or less. And in this case, the shekel has, not only come back to where it was when the war broke out, but it's actually 5% stronger. So that's after some intervention by the central bank here. But the stock market has come back largely. And more importantly, investment continues to flow. And so dollars, especially into the critical tech sector, are continuing to flow well. And in particular, there's almost like I would call it a solidarity effect of many people who are stepping up and investing, which I think is a great development.
So turning to the tech sector, what effect have we had so far from this war on the tech sector? You've had a lot of people called up in the reserves. That means you're losing some of your employees. You said the investment appetite remains, but to some extent, is the tech sector a little bit on hold until this all gets resolved?
Well, what's amazing is that there's a slogan now that Israel Tech delivers no matter what. Actually, there's a website to that effect. Because the resilience is really being seen in the tech companies, and some of it's almost supernatural, because between 10 and 20% of our workforce is now called up. At my company, I have 200 people working at Our Crowd specifically, and we have 35 either in service or spouses whose husbands or wives are in service. So this is a significant impact, except that we're used to it. These people go off to serve on a regular basis throughout the year, and we're built in with redundancy and the ability to compensate. And people just are multitasking, working hard, pure grit. And what we're seeing is that the companies are simply not slowing down in terms of the deliveries and sales, and customers are understanding, what's going on here. I think the biggest effect is I spend a lot of time explaining to both investors and partners around the world politics, when I'd much rather be talking about business, but we're doing the best we can.
So you're doing an extraordinary job, it sounds like, keeping things going. What about new investment, whether it's new rounds in existing companies or new startup companies? Do they have to put their hopes and dreams on hold a little bit until we get past this?
So what's interesting is that there's clearly an impact on the new investment rounds. Some investors are saying, hey, look, I really want to make this investment, but can we just hold off for another couple of weeks or maybe a month until the war is over? It's not going to look good at my investment committee. And there actually now are about a half a dozen initiatives, including one here at our crowd, to build specialized funds which are actually being proactive and are actually today leading investments. We're calling ours the Israel Resilience Fund, where we're raising $15 million, which is not a big amount for us. We manage $2.3 billion at the moment, but we want to put that money to work immediately, and we're doing it with no fees and no carry, which is sort of extraordinary in the venture capital world. But there are a bunch of people doing this, which is actually then acting as a catalytic factor, getting these rounds done, making sure that the startups have an extended runway and aren't seeing any kind of deleterious effect as a result of people wanting to hesitate.
John, what about the longer term? We talked before this all happened, the war happened, about the prospects of expanding out the Abraham Accords, and particularly involving Saudi Arabia, normalizing relations. You actually had been going to Saudi Arabia talking about that. That is on hold for the moment, it appears. But what are your thoughts about what happens after the war is over at some point? Can that be put back on track?
I'm speaking to you now from Abu Dhabi, and I'm here at the Abu Dhabi Finance Week, and the Fortune is having a global summit here. It's remarkable how welcome I am and other Israelis who are here, and how committed the Emirati government is to the long-term strategic goal of normalization. Now, the Saudis are a little, haven't yet caught up with the Emiratis in this process, and they were getting very close. And that's really one of the reasons why I think Hamas chose that moment to attack, to try to prevent it. But I have absolutely no doubt that once the war is over, this will resume. I think the Crown Prince, MBS, has said so directly, that this can resume as soon as the war is over. Now, obviously, this is assuming that the war ends in, something like not an unreasonable time frame, and that we get it behind us, and that we get back on with the very, very important long-term prospects of reconciliation and normalization. I mean, when you look at the long-term, not in the geopolitical context, in terms of the technology and where Israel tech is going to go, there is no doubt in my mind that Israel's strength in artificial intelligence, in semiconductors, in quantum computing, in advanced healthcare, in mobility, in ag tech and sustainability, all of these areas are crying for innovation and breakthroughs, which are coming from a host of Israeli companies. So when I take sort of a venture capital horizon look, which is not next quarter or next year, it's 10 years out, I am certain that not only will we be back on that normalization and reconciliation track, but Israeli tech will be much, much stronger in helping the world solve some key problems.
That was John Medved. He's our crowd founder and CEO, talking about the state of the economy in Israel. It's pretty extraordinary. I think when we go back to when this first started, October 7th, we thought the price of oil would spike up, would stay at an elevated rate. Really hasn't done that.
Yeah.
We thought the Israeli economy would really have a setback. It had a little bit of a hiccup. Seems to have come around again.
Yeah, it's certainly held up here. And I always kind of point out to people here in the U.S. that this is something you have to pay attention to, meaning the companies he's talking about. I mean, you have well over 100 of publicly traded companies here in the U.S. that are either based in Israel or have Israeli origins. Some big ones, too, like Teva, Mobileye, Checkpoint, quite a few here. So if the economy there is struggling here, that means those names, those stocks are going to struggle as well. So there is an investment in this, in a peaceful resolution to this that goes beyond just the humanitarian issue.
And the prospects of going on to Saudi Arabia, normalizing relationship there would be extraordinary, of course. On Friday, we're going to have Richard Haas, the former head of the CFR, the Council of Foreign Relations, come in and tell us about all this, as well as talk about COP28. Remember COP28, Romaine? Remember that's going on over there?
I missed COP27. When was that?
Exactly. Talk about exactly the state of the world and how it's affecting what's going on there. And that's going to be coming up on Friday, and that's going to be at 6 p.m. Eastern Time on Wall Street Week.
All right, always a great lineup on Wall Street Week, and you can catch David Weston every day around this time on the close for our Wall Street Week daily segment. We're rounding out into the final hour of trading here on the close, and the price action today is similar to what we saw on Monday and on Tuesday. Modest gains in the equity market, but we're seeing a resumption of that global bond rally continue, with yields, at least on the shorter end of the curve, seeing most of the activity as a lot of people now really starting to bet that the Fed is going to have no choice but to cut rates sometime in 2024. We'll be back in a moment. This is The Close on Bloomberg. Just about 3 p.m. here in New York. This is the countdown to the close. Let's get a view from the top. Romaine Bostick here.
And I'm Katie Greifeld.
You are Katie Greifeld, by the way. And guess what, Katie Greifeld?
What's that?
The rally's fading a little bit here in equity markets. It wasn't a strong rally to begin with. We're still in the green across the board here, but we're really talking about really modest fractional gains.
Modest, tepid, boring. You could say whatever you want. But yeah, you look at the S&P 500 right now, only up about 0.1%. I will note that volume actually is a little bit higher today, which is a trend change from the past 2 weeks or so, but still it wouldn't necessarily know it by looking at markets right now.
Yeah, absolutely. And I put the mid caps on there because that's really where you're getting the most juice now, is in the mid caps as well as in the Russell 2000 and the small caps here. No real narrative, I think, taking shape there, but I think you are seeing people come back into some of those individual names and trying to find value. Do you know what the biggest gainer right now in the S&P 400 mid cap index is today?
I was hoping you would tell me.
GameStop.
No kidding.
Up 19% here on the day. Why? Don't ask. Flip up the board.
Report at some point, but yeah.
Yeah, who knows? Maybe the meme trade is back, Katie Greifeld. You wrote the whole story about the death of meme ETFs. Maybe it was too soon.
This always happens.
All right, well, the death of the bond rally definitely was premature there. You're really seeing a huge resurgence here as a lot of people really are now pricing in that peak in rates. Right now, we are on pace. What looks like it's going to be one of the best months, I should say, here in November for global bonds going back to 2008.
And it's pretty amazing. You think about what was happening in 2008, what's happening right now, much different stories. But let's talk about some of the individual movers in the equity market. Let's
start. Is GameStop on there?
No, but GM is. We got to talk about GM today. Yeah. I know, close, but GM having a great day, up 9.4%. Of course, we know the reason why. A boost to the dividend, a 33% boost. Its quarterly payout is now going to be 12 cents beginning in 2024. Probably the bigger story there, though, is the $10 billion share buyback plan. That is the biggest ever in GM's history. You can see that shareholders clearly welcoming that.
Yeah, what else you got?
Okay, let's keep going. Let's talk about Las Vegas Sands. This is an interesting one. It's dipping today. It's in the red. That's the most intraday in 2 months at one point here. That's as Miriam Adelson is selling $2 billion worth of stock in Las Vegas Sands to acquire a majority stake in the Dallas Mavericks NBA franchise. We know that that is going through. Got to fund it somehow. You can see shares down about 4.4%. I know we're going to talk about that a little bit later as well.
And you have Foot Locker on there.
Foot Locker, yeah, we talked about it yesterday. Of course, it reported after the bell, and turns out it was pretty good. You can see that reflected in the shares right now. They had a strong Thanksgiving week period. That's good news. They also beat on comp sales, and their top line guidance for the fourth quarter beat estimates as well. So you add it all together, and Foot Locker is absolutely soaring right now, Romaine.
Wow. Yeah. Do they sell Hokas?
They do, actually, which is good because we know that Nike is a little bit of a question mark.
All right, we're 1 hour away from those closing bells. Our cross-platform coverage of today's top stories and market action, it starts right now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. Romaine Bostick alongside Katie Greifeld. We're joined right now by our colleagues Carol Masser and Tim Senovic. Wow. Welcome to our audiences across all of our Bloomberg platforms, television, radio,
That was
originals.
Wow.
Absolutely.
Wow. We're here.
That's absolutely. It's always wild talking to you two, particularly on a day like today where we got a lot of news flow out there. I mean, you can kind of pick your poison, whether you want to talk about deals, whether you want to talk about the global bond rally, or of course you talk about Bill Ackman, who is now talking again. And he has some interesting thoughts about when the Fed might actually start to pivot.
Yeah, well, the Fed president's kind of battled it out about what's going to happen next because it doesn't seem like there's one narrative. The narrative from Bill Ackman, of course, big hedge fund guy, Pershing Square Capital, he is basically saying that, yeah, I think that the Fed is going to actually cut rates sooner rather than later. And he's talking maybe as early as the first quarter. And what's interesting is he talks about the real rate of interest, which is what impacts the economy. He says it keeps increasing as inflation declines, which means more of an impact on the economy. I think that's where he's thinking.
It's certainly a bet that he's making, but the question is, does that bet actually become true, Katie? We talked to Bill Smead over at Smead Capital yesterday, and he had certainly a different take on the economy. He's very concerned that inflation is a lot stickier.
He's negative,
He's
man.
very negative.
Oh.
He's very concerned. He thinks we're in a commodity super cycle like we were in the 70s, like we were in the 80s, and that inflation is here to stay. So he doesn't see the Fed actually cutting rates anytime soon.
I want to talk more about Bill Ackman, though. So he says that's the current macro bet we have on, basically that the Fed is going to cut in the first quarter. I want to know how he is expressing that. We know that he was short the long end 30-year treasuries earlier in the summer. That paid off. Where is he expressing that? I would assume it's in the front end, but would love to get some details.
Yeah.
Details, right, Bill?
Yeah,
You don't know the
I don't
trade.
know. I think you'll get those details after he's closed out the trade.
Yes.
But we should point out too. I mean, because I was looking at when you look at swaps pricing, when you look at SOFR pricing, when you look at everything here, most of those rate cuts are really being priced a little bit later into the year, so like May and June. So the idea that he's betting on a Q1 rate cut is, to a certain extent, a bit of an outlier. So it'll be interesting to see how long he stands by that trade.
Yeah, we should point out more of that conversation in the upcoming episode of the David Rubenstein Show on Bloomberg.
Peer-to-peer.
But what?
It's called peer-to-peer,
Peer-to-peer.
right?
Yeah, I call it the David Rubenstein Show.
Yeah, because that's
Two
like
Titans.
his peer. You get it? It's,
You know, gosh, thanks for the mansplaining. I really so appreciate it.
It's called romaine-splaining, okay?
Take it away, whoever wants it.
Do you guys want to talk about the economy?
Yeah,
can I explain that to you too?
Well, let me tell you about GDP. Third quarter GDP. We also have the
Girl-splaining,
numbers
woman-splaining, I'm up
this morning, a 5.2% annualized pace. You remember the initial number, 4.9%. That was already pretty surprising. Now the final number that we have, that 5.2% pace, we haven't seen that in about 2 years. And you can see on the chart, sorry to our radio audience there, but the chart really tells the story. That is quite an acceleration.
Anomaly?
Yeah, maybe.
Does it mean anything about what's to come?
I don't know. Why is this an anomaly? First of all, I went back because I was looking at some of the predictions at the end of last year for what we would see in GDP growth this year. Nevertheless, pretty much everyone got it wrong. No one even came really close to 5.2%. But when you look at what's driving that,
Everybody thought we were going to have a recession.
Right, but there are real fundamentals driving that. Now, whether that's going to last deeper into 2024, that's a whole nother conversation. But I mean, look, we're 3 quarters in, and I don't think the fourth quarter is going to shake out to be that much different than what we've seen already.
Well, we did hear from the Fed just in the last hour. The Beige Book came out that said, economic activity here in the U.S. has slowed. Consumers have pulled back on that discretionary spending. We're starting to get some numbers in from, the holiday shopping weekend, and it's looking really, really good. It's looking like that discretionary spending is up.
But my rebuttal to that is it very specifically said they were pulling back on discretionary goods spending.
Right.
And that the services
furniture,
was holding up, or
appliances.
particularly travel and leisure was holding up.
Yeah. It makes sense. We bought enough couches in the last couple of years
But
to last us a few years.
I do wonder when the cumulative effect of these higher rates.
I always wanted where you have the 2 couches facing each other in the living room, but my wife
Don't
refuses
talk to your
do
wife.
that. She thinks it's just
Does she
going to
let you interrupt like this? Because if so,
room.
we're going to have a
Her?
conversation.
Oh, she doesn't listen to me. She just walks out of the room.
we can do that?
I don't know if you guys saw this story from the OECD, whether or not you respect their projections or not, but they did talk about the world's advanced economies heading into a deepening slowdown and talking specifically about these markedly higher interest rates taking kind of a toll on activity. And I think it gets accumulative over time. So this higher for longer, you do wonder about the deepening impact it might have going forward.
Lots to chew on.
That's
that's it, Carol.
That's womansplaining.
You like those long pauses. Dramatic for dramatic effect.
Works really well on radio and television.
Yeah, I mean for television, at least you see us. But if you're on radio,
you are
you're like,
welcome, everybody.
Did the antenna just go out? What's that? How do you get radio signals?
Honey, could you turn up the volume?
I don't know.
All right, guys, we're going to be back in less than an
They should
hour's
put this on YouTube.
time. Radio, TV, YouTube, and Bloomberg Originals. We'll be back at 4 p.m. Wall
On
Street
Vimeo.
time. Beyond the Bell Metaverse. It's coming.
We continue our coverage of counting down to the closing bell here on Bloomberg Television. Just about 50 minutes to go until we get there. Cheryl Pate joining us right now. She's the senior portfolio manager over at Angel Oak Capital, helping us count down to the bells on a day where I think everybody is still talking about the macro, particularly in light of the GDP revisions we got, particularly in light of some of the Fed speak that we got today out of Bostic and a few other folks here. And it kind of raises the whole question as to a market right now, Cheryl, the bond market, I should say, and the options market, which seems to be very persistently pricing in Fed cuts pretty soon, within the next 6 months, effectively here. And I'm wondering if you think that is on point or maybe too premature.
Yeah, I do think it's a little bit of a balance when we weigh the data that has come out lately, and especially starting to see some softening in consumption from the consumer side, PCE slowing a little bit more than expected. But I think that is in line with our base case, higher for longer over the medium term, and moving into a cut scenario maybe by next summer, which seems to be in line with what the bond market is now projecting May-June timeframe. Perhaps a little early, but somewhat in line, I think, with what we will see as you balance, tighter financial conditions, but a still strong labor market and consumer.
If we do get to that point where we are going to see rate cuts, and we've had some people, including on this program today, who actually see multiple rate cuts in 2024 and into 2025, how much does that change the complexion of where you invest along, whether it's in the Treasury curve or even in the corporate bond market? What does that do to how you view duration?
Yeah, I think, and it will depend on, how quickly we move into a cutting environment and how steep those cuts are. I think our house view is we will see a couple in 2024. Maybe that accelerates towards the fourth quarter of next year, but more into 25. So I feel like it's a little bit early on sort of lengthening duration here. We like to be on the shorter duration side in the mean term. But I think that's more, fourth quarter 24 and into early 25 is where we really start to see the velocity of the cuts pick up.
And Cheryl, let's get specific here on where you actually see opportunities. I'm going through your notes right now, and it's interesting. You mentioned large cap bank equities, community bank equities, and then you say regional banks more challenged. What is the current temperature on those regional banks that had so many troubles earlier this year?
Yeah, I think it's interesting. We've now gone through 3 earnings cycles since the regional bank crisis back in March. And I think what we've learned a few things. We've learned certainly that the banking system is very resilient and earnings have held up pretty well, as has credit. I think where we're most concerned, on a forward look, is clearly there will be more regulation to come out of this, and frankly, mostly in that sort of 100 to 250 billion regional bank spot, where we did see loosening over the last several years, and that will see, the largest delta of change, meaning expenses are going to ramp up more significantly for that cohort versus the large banks, which I think benefit from not only a more diversified business model, capital markets, wealth management, and the like, but also a skew to consumer who's holding up dramatically well in this cycle thus far. And then on the other end of the spectrum, we look at a community bank model where there is huge value to their deposit franchises, particularly in a higher for longer environment.
And Cheryl, it feels like the volume has come down a little bit on some of the commercial real estate concerns that were really loud and apparent earlier this year. When it comes to the regional banks, though, that specific segment, what does the CRE exposure look like there?
Yeah, I think the devil is really in the details in the banks. I think one of the beauties of the sector is it is very transparent in terms of regular quarterly reporting, whether you're public or private. But the devil's in the details, and I think parsing out not only the commercial real estate exposure, but the pockets that we're most concerned about, office CRE in large metropolitan areas, for example. And I think the disclosure has gotten much better since the failures of Silicon Valley and Signature Bank back in March. We've gotten more granularity on not only office CRE as a percent of loans, but also the LTVs, the maturity wall. And I think that's given investors much more confidence. When you look at regional banks, large cap banks, community banks, as a whole, you'd be very hard pressed to find office as more than 10% of any bank balance sheet. So it is relatively contained from that perspective, as well as the underwriting.
I am curious about the about a deal, Cheryl, not just in the banking sector, but really writ large, and whether we are going to see a pickup in that. There's been some semblance of a pickup in activity in the last couple of months of the year here, and I'm wondering, do we kind of get back to some of those healthier levels that we saw prior to when the Fed got in the way?
In terms of M&A?
Yes, yes.
Yeah, no, I think absolutely that's one of the key themes that we're looking for in 2024. We're still dealing with a higher cost environment, which will incentivize M&A. And I think, some of the pushback, bank investors particularly look at for bank M&A is there's regulation changes coming. Well, I think part of that, part and parcel, will be increased M&A, particularly in that cohort where we're, most concerned about the higher costs to come. Scale is going to matter in terms of driving better profitability. And I think that's, inorganic growth will be a key trend next year.
All right, Cheryl, it's always great to catch up with you. Really appreciate your time. That is Cheryl Pate of Angel Oak Capital. Now coming up, we'll talk with Nathan Will. He is head of municipal credit research over at Vanguard. Why he says there's tremendous value in munis right now and what he sees ahead for 2024.
And EM stocks looking to extend their winning streak to a fifth straight week. Christine Philpotts, portfolio manager and senior research analyst at Ariel Investments, is going to be giving us her insights in just a bit.
And we're counting it down to the closing bells with Amanda Agati, PNC Asset Management Group CIO. All that and more coming up. This is The Close on Bloomberg. Time now for our Muni Moment, and our next guest says there's tremendous value in bonds right now. He joins us now. His name is Nathan Will. He is head of municipal credit research at Vanguard. And let's talk about this tremendous value as it relates to the muni market. Is this a close your eyes and just buy environment, or is there a little more nuance to that?
Thanks, Katie. So it's great to be here. Yeah, I'd say that we believe we're still going through somewhat of a muni renaissance. As always, munis remain a very high-quality asset class with very low default rates. And looking at yields in the market right now, they're tremendously attractive. We haven't seen yields like this in years, both on an absolute basis and for those investors in high-tax states such as California, New York, and New Jersey on a tax-equivalent basis. And besides all of that, credit is still in a very good position. We've got reserves and rainy day funds topped off. So overall, a very, very strong backdrop for munis as we head into 2024.
And Nathan, I like to talk about munis because you talk about actual things, physical things that you can feel and touch and see. Talk to me about toll roads and what you're seeing there.
Well, toll roads are a very good sector right now. The ridership has been strong, or the number of travelers since the pandemic, and they tend to keep a ton of liquidity on their balance sheet, usually in excess of 1,000 days. So higher grade toll roads, always a very good bet.
What else out there do you see that's attractive, though, Nathan? I mean, beyond just sort of the normal stuff.
So we're focused right now on the healthcare sector, particularly not-for-profit hospitals. This is a very large issuer in the muni market, a very important sector. So, during the pandemic and post-pandemic, there was a lot of pressure on not-for-profit hospitals, mostly coming on the labor side. And as we've seen inflation start to moderate, and we're seeing strong utilization of beds And we're seeing operating margins start to improve there. We think there's a lot of value, and we're finding high-grade healthcare very attractive. Now, you have to be very selective in this sector. So, you can lean on an experienced credit research team like ours.
Okay, and it certainly is experience. Well, can you dive a little bit deeper into that, though, too? Because, I mean, it's easy to say, okay, yeah, I mean, you pick out high-quality stuff, and obviously Vanguard, you have a whole army of folks to sort all that out for you here. But, I mean, kind of what's the general criteria where when you look at some of those hospital operators and you can kind of separate the wheat from the chaff? What sort of creates that separation?
Yeah, you want to hone in on those hospitals that are market leaders, so they own most of the market share in a particular city or region, and also that tend to have a unique specialty. So children's hospitals is one example.
So Children's Hospital, definitely an area to keep an eye on. So too, in your notes, you write public mass transit. Of course, I'm speaking to you from New York City, where it's pretty much all we talk about. What are you seeing when it comes to mass transit broadly?
Well, public transit is a sector that we're keeping an eye on, after the pandemic. Ridership has not, particularly in areas such as New York, the MTA in particular, ridership has not returned to pre-pandemic levels. However, that can be mitigated by a lot of factors. In the case of the MTA in particular, it's not wholly dependent on fare box. There are dedicated taxes and other sources of revenues that also support operations. So, we ultimately do think that, public transit will be resilient in this new normal as we move forward in a more flexible and work from home environment. But, we're just keeping an eye on that.
All right, Nathan, got to leave it there. Enjoyed this conversation. That is Nathan Will. He is head of municipal credit research over at Vanguard. Now coming up, maybe the magic is fizzling. Why some are looking at Disney's latest animated film offering as a sign that the old guard isn't resonating in the new age. This is The Close on Bloomberg. Wish, Disney's latest animated musical, it's being marked as a box office dud, delivering just half of its expected ticket sales over the Thanksgiving weekend. Now, Disney studio executives are left wondering if the classic fairy tale princess story is nearly as appealing as it once was. And Romaine, that's one theory, that maybe little girls, and I don't talk to a lot of them, but maybe they aren't gravitating towards the princess story like they once were, or maybe people just aren't going out to theaters as much as they were.
Or maybe it was just a bad movie.
Yeah,
I mean, because, and I'm not being glib. I mean, this was kind of a mashup. We kind of forget. I mean, yeah, it's about a princess, but this was kind of where they bring all the characters across various Disney properties into this. So it was kind of this mishmash of stuff. And I don't know. I mean, even seeing the trailers, you were like, what exactly is this about?
Yeah, well, you take a look at the ratings. I believe it has a 50% rating from Rotten Tomatoes.
That's not awful.
I think that's not good, though.
I mean, it's not, well, I mean, technically, Katie, it's not bad either. It's basically
true.
right in the middle here.
Extremely neutral.
We should point out, too, Bob Iger, the CEO of Disney, is speaking, spoke a little bit earlier at this Deal Books Summit here in New York, where he was addressing some of these issues, particularly around the media business, all the stuff that went down in Florida. And he also addressed the whole question about the linear TV business, which, remember, he kind of alluded a couple months ago that they were going to sell this business. Then a couple days ago, he said, well, maybe not. And now he was asked today about it, and he said pretty emphatically that right now that linear business is, quote, not for sale.
Not for sale, yeah. Some pretty strong comments there. And like you mentioned, big reversal. So I don't know where that leaves the path forward for the linear TV business. It's going to be interesting to watch them try to
Well, I hope it's strong, given that we both make a living from the linear TV business. Maybe they can make a movie like with just a bunch of
television anchors?
Yeah, television anchors who just wander the earth aimlessly trying to solve people's problems.
Talking about the Fed.
It could be like Quantum Leap.
Yeah.
Kung Fu. Did you ever see that show?
I haven't seen it either.
With David Carradine. It was great.
Yeah.
He just roamed the earth, looking to help people.
I want to relate to you.
Or the A-Team.
Yeah.
You want to relate to me, but you're just waiting.
I'm not a movie hound, so I don't know. In any case, Wish was a flop. This is The Close on Bloomberg.
This is the countdown to the close. Just about 30 minutes left to go here in the trading day, Katie, and the price action kind of similar to what we've seen over the last couple of days.
A little bit muted, even though you do have more volume than you've seen maybe in the past week or so. You take a look at the sector level there, and we do have some action to talk about. There is green on the screen. Real estate up by 0.8%. Financials also having a good day, up about 0.6%. Materials, industrials as well. But you go down the list here, and you definitely have some losers, if you want to call them that. Utilities, energy, and communication services. And we were just talking about this, Romaine. Energy really taking a leg lower just in the past hour or so. Had been higher on the day, now down about 1%, even though crude oil still higher.
Losers.
Losers.
You can't use that word anymore.
Underperformers.
They're underperformers. There you go here. Let's take a look at some of the individual movers here on the day. And we're going to start with the winners, the overperformers here on the day. We're going to get a lot of earnings, believe it or not, after the bell tonight, primarily in the software space, and the biggest one of them all, that's going to be Salesforce. Those shares higher heading into that report by about 2.5%. We're also going to get PVH after the bell as well, an apparel maker, also moving higher into that report. And then two interesting stories here. One on GameStop. The shares at one point were up almost 30% here on the day, up 18% now, having its best day going back to March. And if you're looking for a reason why, there isn't one. And that really seems to be the narrative for any time this stock has these outsized moves. We should point out that that company is scheduled to report earnings next week. So maybe there's some speculation out there that's driving the share movement. Meanwhile, no speculation needed for Leslie's. This is the company that makes pool equipment here. The outlook was not good. The shares not having a good day. A 15% drop, Katie Greifeld, here as we march towards the close.
Well, let's go from U.S. equities over to emerging markets equities, because what a month it has been. We're going to break it down now with Christine Philpott. She is Ariel Investment Portfolio Manager, joining us on set right now. It's great to see you, Christine. And it's been a bumper month, to put it mildly, when it comes to bonds, stocks, currencies in emerging markets. You take a look at what's happened in the past month. Do you think that's sustainable heading into 2024?
Yeah, I think what we've seen in November is a preview of what we're going to be seeing in 2024. And I think there's a couple of main drivers for that. One, I think that the term higher for longer will officially be retired by the time we reach January. And so I think this provides a nice opportunity to see rates continuing to come down and inflation expectations coming down, not only the U.S., but the ramifications it has for emerging markets, which are really in a very good position to continue easing, in some cases being able to ease more forcefully, given that the U.S. rates are, have peaked. So I think that's one main driver. I think, the other thing we're seeing is that emerging market equities are still at, tremendous discounts, valuation discounts relative to developed market peers. So you have the MSCI EM index that's trading at 11 times forward PE versus the S&P at 19 times forward PE. Yeah. That's despite much higher earnings growth expectations.
I'm curious about that valuation discount, because I was having this conversation with someone earlier this week, and at least the measure that they were pointing out to me, it was like the widest discount that we've seen in more than a year. But I'm curious as to what drove that discount in the first place, because that gives you a better sense of whether it'll narrow and how fast.
Yeah, absolutely. So a big part of that discount is driven by China. Oh, okay. So China's 30% of the EM benchmark. And we see the equity risk premium for Chinese equities at all-time highs, whereas the U.S. equity risk premium is at all-time lows. I think there's a couple of drivers for that I think will start to unwind in 2024. One is there's been a lot of concern around the real estate sector in China. Mm-hmm. However, I think that investors are pricing in too aggressive of a downside in terms of real estate pricing, given loan-to-value ratios that are only at about 50%, and given the fact that we're seeing new starts having fallen 60% from peak to current levels, yeah. And inventories are actually starting to decline. So whereas we think there's still some risk clearly in the real estate sector in China, we think that investors are overly pricing that risk, which is why we're seeing the Chinese markets trade at such low valuations, despite the growth potential there.
But do you think that pendulum is going to swing back? Because even in some of the folks I've talked to on this program, as well as some of the outlooks that have now come out for 2024, around emerging markets, you're seeing much more of an allocation, or at least of a tilt, towards non-China EM. And I'm wondering that if that starts to suck up a lot of money, in theory, then that's less money that would then go back into China if you think there's an upswing.
Yeah, so I think that if you look at the emerging markets universe ex-China, we see tremendous opportunities there as well, whether it's a market like Brazil, which we think is just at the inflection point of earnings growth acceleration, whether it's countries in Central and Eastern Europe that are having their growth outlooks be improving and continuously increasing given the ability to ease and drive growth, whether it's markets like the Middle East and UAE that have seen record growth in real estate sector. We're able to take advantage of those opportunities beyond China and really seeing some attractive stocks in that broader universe that's able to benefit, even if the Chinese economy were to remain status quo.
I want to get a little bit philosophical here about how investors should actually approach EM investing, because you talk about, the benchmark level and China's outsized influence there, 30% or so. Should investors be looking to basically unbundle EM? Should you be really trying to get specific here?
So we think that EM provides such great opportunities for stock picking. So investors really need to look, as you said, beyond the benchmarks to uncover value and really be able to do active management, because we've seen a wide dispersion of returns, not only across countries, but even within specific countries. And so active managers like us are really well positioned to be able to do that homework and due diligence to really be able to uncover those untapped opportunities. In terms of the broader unbundling, I think again comes down to being able to actively manage and determine the opportunities you're seeing in the market, and at the stock specific level, be able to see who has idiosyncratic drivers for earnings growth that's not being valued by the market, oftentimes because stocks or entire countries have been ignored, and being able to take advantage of those opportunities to tap into them ahead of the rest of the market.
Well, when you think about idiosyncratic factors, let's talk a little bit about politics. Obviously, the Fed has a lot of influence when it comes to emerging markets. But you think about some of the political news we've gotten in the past few weeks, of course, what's going on in Argentina. When you're doing that active management due diligence, how are you weighing the geopolitical risks as well?
So we think geopolitical risk and regulatory risk are really paramount, not just for emerging market investing, but for investing, period. I know the U.S. clearly has some political risk to think about heading into 2024. So that being said, if you take a market like Argentina, we see the prospects having increased meaningfully with the elections, particularly given that it seems like the cabinet that Milei is putting together is a fairly reasonable cabinet of technocrats. That being said, one has to be cautious of the level of massive restructuring that needs to occur from an economic level, the measures that need to be taken to be able to bring inflation levels that are now over 100% back down. And that could lead to a lot of short-term pain, including recession. So one key question is, will this government be able to implement the necessary reforms with the support of Congress in order to have a really sustainable path towards a better future for the Argentine economy? But those are the type of questions and factors that we take into account as we try to scour the globe for untapped opportunities.
Well, that actually raises the question. I'm going to I know Katie just unbundled EM, but I'm going to bundle it back together, because you mentioned how you like Brazil, and we have, let's just face it, a little bit of a wild card right now in Argentina, and how Milei is really going to play out and his policy proposals. And I'm wondering, do you ever worry about, I guess, the correlations between economies like that? Brazil, obviously geographically they're close, but they do have a trade relationship as well. So if one does bad, you would think there would be some impact on the other.
Well, actually, if you look at the trade relationships, there could be a risk of, all of Latin America being bundled with one brush, but I think that would be the wrong way to think about it. Okay. So I think within Brazil, it's really on a very different economic path relative to Argentina, given where they are in their economic cycle, given where they are in their inflation and monetary cycle. They're really poised to benefit from growth acceleration. And looking beyond the top-down level, we're able to find some really attractive stock-specific opportunities like Hapvida, which is a health insurance company that's vertically integrated, that manages its own set of hospitals, that's seeing a really interesting inflection point in their EBITDA as pricing has started to increase at a faster pace, helping to offset some of the cost and healthcare usage increases of the prior years. So that's just one of the examples of where we take into account the top-down factors, but we really do bottom-up stock picking to be able to determine those winners of losers. And what's happening in Argentina is not going to affect a stock like Hapvida.
Christine, it's always fantastic to speak with you. Hope to see you again soon. That is Christine Philpotts of Ariel Investment. Now coming up, it's the top three, our new segment where we focus in on the top three movers and shakers at the center of the day's biggest stories. That's next. This is The Close on Bloomberg. All right, time now for the top three. Every day at this time, we do a deep dive into the people at the center of today's top stories. Scarlett Fu joins us right now. Scarlett, who are you watching?
I'm watching Jack Ma. He is speaking out loud. I mean, virtually, because he did it on an employee forum. But he's been pretty quiet for years after Beijing cracked down on his e-commerce giant Alibaba. But he unexpectedly posted in an internal chat forum urging for the company Alibaba to course correct. Of course, you know that Alibaba is kind of a shadow of its former self. The stock is really trading near its lowest value this year. It's got rivals like ByteDance and Pinduoduo. There's an executive shuffle at the top. Remember the whole, we're going to split up into 6 companies and spin off the cloud arm? Yeah, that's not happening.
Yeah, I'm just surprised that he's actually disinvolved, because there's been so many questions as to whether he was still involved with the company or not involved with the company, or whether maybe this is just a one-off. But it seems to suggest, if you read in between the lines, that he's had maybe a little bit more hands-on than we thought.
And can you just quickly clear something up for me? So this was in a chat room, on a message board. We didn't actually see the man speak.
We didn't see the man speak. This was in an employee forum, too, so it's internal. Yeah, but it was a message to everyone else in the company. Hey, I'm here, and hey, I'm watching.
And hey, get a little bit better. Let's talk about Mark Cuban, though, because that's who I'm watching. He's selling a majority stake in the Dallas Mavericks to Miriam Adelson. She is, of course, the widow of casino magnate Sheldon Adelson. She is selling $2 billion of stock in Las Vegas Sands in order to fund and conduct that transaction. Cuban, of course, he's expected rather to continue owning part of the team. And of course, he's been involved with the Dallas Mavericks, I think, since 2000. So this is definitely a long-running relationship here.
Yeah, I believe he bought the team for $285 million back in 2000. So at the reported $3.5 billion value, that's equal to a 1,100% return.
It's not bad.
Not bad.
Wow. Yeah, well, good for him. Another story I'm keeping an eye on, another person I'm keeping an eye on, is somebody that we don't actually really know very well. His name is Alan Alcorn, and you may not know the name, but you definitely know what he invented. Pong.
Oh! Wait,
today,
do you know what Pong
November
is?
29th, 1972, Atari released its very first video game, Pong, and it was a very simple game. There you have it. I know anyone under the age of 40 looking at it is like, what?
No,
but this was revolutionary. And what I was going down the rabbit hole of sort of the creation of this, and I came across 2 interesting nuggets. I forgot Steve Jobs was actually a part of this project. Wow. Apparently he was drifting. He had dropped out of college. He really had no drift. And somehow he talked his way into the Atari offices. They said he was a little troublesome, but they thought that he was smart. And he ended up working with this research team on Pong. And then they later found out that most of the expertise didn't come from him. Steve Wozniak had actually built a somewhat similar video game that Steve Jobs had taken with him to show exactly what his work.
Of course, that's how it happened.
So anyway. All right, we'll be back in a moment with more stories about Pong. This is Bloomberg. This is the countdown to the close. I'm Romaine Bostick, alongside Scarlett Fu. We're counting you down to the closing bell and taking you to the bell and beyond. Interesting price action, Scarlett, that seems to kind of be maybe a little bit of a sort of Groundhog Day of what we saw on Monday and Tuesday.
Yeah, but not for the Russell 2000. That one's flying high, led by the financials, and certainly on the back of a GDP revision that surprised almost everyone. A 5-handle for third quarter growth.
Well, I was interested in that too, because yes, they had mid-caps up, Russell 2000 up, and I was looking at the biggest contributor. The financials a big contributor, but some of the apparel makers too. I think the biggest point contributor was Foot Locker, which was like, who knew? I mean, Pong is back, why not Foot Locker? American Eagle, and then of course there was that interesting story on Rover being taken private.
By Blackstone.
By Blackstone, and those shares are up like 28% or something.
And of course, we also have General Motors up as much as 12%.
That's
but
insane.
This is really about the company appeasing investors because the stock is still holding near its lowest since the summer of 2020.
I kind of feel like it's a good move on Mary Barra's part, because this sort of came against the backdrop of those EV sales, or more importantly, EV profitability that isn't really there. And so how better to soothe investors than just say, okay, we're just going to give you a bunch of cash back. We're going to buy back $10 billion in stock, raise the dividend, and we promise you we'll be profitable in a couple
years. Not just raise the dividend, hike it by 33%.
Yeah, so interesting. So anyway, you add that all together, and you're talking about the best day we've seen in GM in what, like 3 years?
Yeah, since March 2020.
Absolutely. Here, a lot of interesting stories out there in the market here on the day, both in terms of the aggregate market as well as some of the individual stories. Let's get to Amanda Agati to help count down to those closing bells. PNC Asset Management All right, Amanda, I'm going to start broad here, and don't worry, I'm going to avoid any Pong questions for you. But I am curious here just about sentiment overall in the market as we get towards year end, and particularly as people now start to look at 2024, and it's become much more of a conversation, not about higher for longer, but about whether the Fed is done and whether the Fed will cut rates and whether that will then prove to be a catalyst for equities going forward.
Well, that absolutely is the topic du jour. And I think investors and really the market at large are telling you exactly what the sentiment is around that topic. Market pricing in 100+ basis points of rate cuts seemingly happening almost imminently. And we just would say, and I've been saying all year, #delusional. It applies to a whole bunch of different aspects of this market rally, but we certainly are not in the camp that we would expect that kind of rate cutting environment in 2024. But the move in small caps, the move in sort of earlier cyclicals, the junkier kind of rallies that we've started to see here are all in anticipation of Fed is clearly done, Fed is out of the driver's seat, and we're going to be seeing rate cuts happening here pretty soon. But I think it's just way too premature to be talking about rate cuts.
Okay, well, fair enough, and I agree with you. So let's start talking about maybe what's happening in the here and now. We talk about the main pillar of this economy being consumer spending. We've already got a taste of what happened on Black Friday and in the weeks leading up to that here. Are you finding enough confidence in consumer spending that is going to hold up deeper into 2024?
It does seem like for right now, consumer spending is hanging in there. But I think when you look under the hood at actual behavior, consumer behavior, there's clearly some shifts that are happening. And so a lot of really strong results coming out of Black Friday, certainly Cyber Monday. The early look at it is, record-breaking spending levels, but it's a total mix shift. And so Barbies, Call of Duty, some of those lower ticket items are definitely carrying the story this holiday season. We're not seeing the same sort of backing up the truck on the part of consumer behavior in bigger ticket items, iPhones, car sales, appliances, and so on. And so I think that's very much indicative of sort of the later innings of the cycle here. Consumers are still spending, still certainly hanging in there, but definitely this mix shift. And I think it speaks volumes about how the consumer is starting to tire here. It's been the workhorse of the cycle for the last few years. And so reasonable to take a little bit of a breath here this holiday season.
Sure, that might be what's happening on the consumer side, but you look at the financial markets, you've got bonds rallying, you've got stocks holding on to their November rally. How much of this price action is end of the year window dressing versus actual positioning for next year, for the months to come?
I don't think there's a whole lot of positioning action that's happening right now. I think it's just sort of a continuation of what we've seen all year. Very few winners, a lot of losers on a relative performance basis. And so the rally that we've seen has been very narrowly led. Even the bounce after the correction earlier in the fall has been fairly narrowly led. And so I'm not sure that there's, fundamental or strategic repositioning on the part of investors here. There certainly are some value options. I mean, there's a number of names out there that look fairly attractive, and certainly some sectors and industries that look attractive. We're not saying that things don't look attractive here, but it's kind of a snoozer of a story. It's a continuation of a story that's been, underway for the better part of the last year plus.
We were talking about how General Motors was trying to appease its investor base with that big dividend increase and the accelerated share buyback program. Is that something that is enough to keep investors in it, or is this 10% rally we're seeing more of a knee-jerk reaction, and do you see more companies pulling off moves like that?
I don't know that I would necessarily say we expect companies to pull off material moves like that. I think it is certainly notable that GM did that, and I think that stock was very undervalued, had been beaten up pretty significantly here. So I think there is a reasonable rally to be had there, given the capital discipline that they're taking and the capital allocation that they're making. So it's a strong vote of confidence for investors. But we're still very much in the later innings of this cycle, and I don't think it's entirely clear yet whether we're going to tip into recession, though it may be very mild in nature or not next year. And so I think companies are still going to continue to be pretty disciplined with the cash on their balance sheet. I think there's still going to be some hesitation to do much until we get a lot more clarity on what 2024 likely holds.
We were remiss in letting you go, Amanda, without at least acknowledging this bond rally that we're seeing here in the U.S. and really around the globe. And kind of outpacing to a certain extent some of the gains that we're seeing in the equity space. And I'm wondering, what do you think is driving that? Is that all just about the Fed and the idea that the Fed is going to cut, or is there more to it?
I think it's entirely a function of the Fed. The Fed speak has really been in a high volatility regime. We've been talking about a high volatility regime as it relates to market behavior for quite some time, but Fed speak has also been in a high volatility regime. In any given day, you can have a hawkish speech and a dovish speech. And so I think the market, the path of least resistance for the market and the momentum that we're seeing is the market believes the Fed is done. You've heard a number of speeches kind of confirm that.
Yeah.
And so the market is very much focused on lower rates ahead. And we just think it's a little bit premature for that.
Yeah, we got that hawk and dove dynamic today with, what was it, Barkin and Bostic, of course, taking different approaches. And then yesterday we had a couple people. So who knows? They don't even know. Amanda, great to talk to you. We'll catch up with you again soon, I'm sure. Amanda Agati over at PNC Asset Management, helping us count down to the closing bell. We're just about 2 minutes away from that. Stocks now moving into the red, at least on the S&P and the NASDAQ, though the small caps and mid caps holding up as we set you up here for full coverage as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Scarlett Fu. We're counting you down to the closing bell. And here to help take us beyond the bell. It's a global simulcast with our friends Carol Massar and Tim Stenovic. Welcome to our audiences across our Bloomberg platforms. On a day, actually, we just saw, Carol, as the television shot showed the room that you and Tim are in. The big headline at the top of the screen there was stocks lose steam heading into the close.
It's like another meh day when it comes to stocks. And I think it's once again a day about we're watching where treasuries are. I'm still shocked, 4.26, I think, on the 10-year note. It's pretty remarkable. I've been thinking about, though, this lower rate environment, if it really sticks. You know, I was curious about the banks. I'm looking at the KBW Bank Index. It's up 2% today. And I was trying to get my head around it. Is it this idea of maybe a soft landing? And so that's good for financials? Is it that they've already got loans at higher rates that are out there? They're making a lot of money maybe on credit cards if the default rates aren't too high. I'm trying to understand the rally that we're seeing specifically in financials today.
You got to have some math days in a month where the S&P 500 is up around 8.5%. We did just speak to Amy Magnotta, the co-chief investment officer at Athegenos Capital, who's really bullish toward the end of the year and early January, saying that stocks are going to continue to rally at the end of the year, but may lose steam toward the beginning of next year.
And maybe it's people looking ahead as well. Banks have been a value trap for so long that if you're looking around to see what might provide some value, you could always look at banks. On a day where oil prices are climbing before the OPEC Plus meeting, you have energy stocks down 0.9%. So the traditional levers that you would count on to drive certain sectors are not really working here.
Yeah, interesting price action. It kind of makes you wonder, too, who actually is doing that. You look at some of the block trades we got this morning, a lot of this price action being driven by a very small group of people. The net effect of it all is a market that, at least on this Wednesday afternoon, is relatively unchanged. The Dow Jones Industrial Average is going to hold on to its gains, but only up by about just a fraction of 1/10% here, about 14 points higher. The S&P lower by 4 points, or about 1/10%. The NASDAQ Composite lower by 23 points, or 0.2%. And we just talked about those small caps here. That is your outperformer on the day, 0.6% gain for the Russell 2000.
Yeah, and I'm going to go back to the big caps, if I may. S&P 500, you're looking at about 285 names gaining ground on this Wednesday, 216 to the downside. And Scarlett, we've got about 2 unchanged here.
And for Met Day, trading in the S&P 500 is actually about 15-16% above the 20-day average. So that's a head scratcher. All right, let's take a look at the industry groups. You've got banks. Carol, you mentioned KBW Bank Index. All 15 names in the S&P 500 are higher, led by Key Corp. And then consumer durable and apparel up by 1.25%, and real estate investment trusts bring up the rear. On the downside, you have media and entertainment losing 1.4%. Energy stocks, food, beverage, and tobacco each down about 0.9%.
All right, guys, let's get to some of the individual gainers, if I may, in today's trade. Foot Locker, really an outperformer, up 21% at its highs today, finishing the day with a gain of about 16%. The company raising its full-year forecast, citing strong results over the Thanksgiving week and progress in its strategic growth plan. The retailer now expecting a full-year comp sales decline of 8.5% to 9%, but the previous forecast was of as much as 10%. The CEO, Mary Dillon, calling it a reset year for the company. She did talk about the consumer, though, and I thought this was interesting. On a conference call with analysts, she said customers remain discerning with their discretionary dollars. She said she expects that economic backdrop to remain as retailers charge into the crucial holiday shopping season. So we'll watch holiday numbers as we move along here. General Motors, got to mention, that is the number 2 gainer in the S&P 500 today. That stock finishing off its highs, but still with a 9.4% gain.
Yeah.
And this after the biggest ever buyback. You want to do Salesforce?
Yeah, Salesforce earnings are crossing the wire right now. Interesting numbers here when we talk about what came in the third quarter. Operating income looks like it's coming in at a beat at $2.72 a share. As far as the revenue, that was up about 11% year over year. $8.72 billion is the number. And I'm not quite sure what the comp is on that here. Actually is a beat, excuse me. The comp is $8.1 billion, so a slight beat for revenue in the third quarter. Here's your forecast for the fourth quarter. The company is saying that revenue will come in a range of $9.2 billion to $9.23. That's pretty much around what the street was looking at on average at $9.22. And adjusted EPS also looks like it's going to be just around what the street was looking for, a range that the company is giving of $2.25 to $2.26 a share.
And what's notable as well about Salesforce is its operating margin is 31.2%. That is higher than what analysts had anticipated. They were looking for 30.4%. And Salesforce has done a lot of work on improving profitability. That's been its focus. What it really needs to focus now on is reigniting sales growth, because that 11% increase in revenue remained that you just mentioned at $8.72 billion. That is the third straight quarter sales have grown 11%. And that's something investors are going to start fixating on.
Yeah, Mark Benioff is certainly fixated on it. He, in the press release, saying, quote, "We're now the third largest enterprise software company by revenue, the number 1 AI CRM, and the number 1 enterprise apps company." He says they're bringing AI, CRM, and trust together in a single integrated platform.
Well, the question, though, is really when do you sort of get a return to some of that sort of phenomenal growth that I think investors have gotten used to? I mean, we're now talking about low double-digit growth for a company that had been growing at 20-30% on a quarter-to-quarter basis here. So if AI really is the salvation here, why aren't we seeing the same type of growth rates that we're seeing for some of the other companies that are in the AI space?
Well, meantime, we are seeing now Salesforce up about 2.9% here, and the company so seeing a little bit of a kick to the upside now. Also talking about fiscal year revenue of 34.75 to 34.8 billion. It had seen 34.7 to 34.8, so it looks like it's basically kind of confirming that forecast, Scarlett.
And I'm glad you bring up the AI question, because that's something that everyone's going to focus on in the conference call. We know ServiceNow, a competitor, raised its full year guidance, and in particular, it cited AI strengthening the market dynamics for enterprise software. So that's the question that's going to be put to Salesforce. What does AI do in terms of the sales of its products, in terms of its other product lines?
And there's also a question, too, I guess, about the strategy that Benioff takes. I remember, what got this company to the size that it is right now is because of acquisitions. And we know, given the activist investors who, of course, really put a lot of pressure on him, and really just kind of overall market forces that said, look, we want you to be a little bit leaner, or at least a little bit more efficient in costs. And that means not just shelling out, $20 billion for every company that, catches your eye.
Well, how much of that has to do with, a higher interest rate environment versus a lower interest rate environment? It was interesting. Benioff was, kind of a player in the last week over the OpenAI saga when he was offering jobs to anyone who would leave OpenAI. And he actually got some pushback and said, we're not interested in coming to a company like Salesforce. We want to stay at OpenAI if Sam Altman indeed comes back.
All right, everybody, we continue to hear from the software application infrastructure software company. Snowflake just out, and the stock's up about 8% here in the after hours. So it is popping in a big way. Let's go through the numbers, and let's get to fiscal year adjusted operating margin, 7%. It had seen 5%. That is quite a bump up to their outlook there. Third quarter revenue. So let's go back to the quarter that they just went through. $734.2 million. The estimate is $713.8 million. Third quarter adjusted diluted EPS, 25 cents a share. That is 9 cents better than what the street was expecting. And they see fiscal year product revenue of $2.65 billion. They had seen $2.6 to $2.61 billion. So that's pretty optimistic. Stock's up about 22% this year, but nonetheless, investors definitely very much pleased with what they're hearing about the outlook in this company, up at about 9.5% now.
Yeah, that's the best performing stock in after hours trading. I do want to flip just real quickly to the worst performing stock in after hours trading, which is another software company, and this is Pure Storage, obviously a much different business here. But when we talk talk about sort of the guidance that these companies are giving and whether they not only meet the expectations in terms of beating the targets, but really provide investors with enough semblance of where the growth is going to come from. You're definitely not seeing it here. The company basically in line on the quarter, most recent quarter in the third quarter, but that fourth quarter outlook causing some concern, particularly on the margin side, which they're forecasting is going to come in weaker than what the street had expected.
It's so interesting to me to hear these software companies, enterprise software companies, as a proxy for IT spending by companies in an environment where we already know consumers continue to spend even with the signs that the economy is slowing around the corner early into next year. To what extent are enterprises and companies much, much more cautious than consumers who continue to spend?
I guess it depends on where they're spending. Are they spending on, enterprise AI or enterprise data, or are they spending on security and IT to sort of keep their companies safe?
Well, I think we talked, I don't know if it was yesterday, but we talked about this recently, with Zuckerberg and that year of efficiency.
Yeah.
I think a lot of people woke up, a lot of CEOs woke up, and they saw, look, there's a lot of fat that they can trim. And when you look, I know Meta was kind of an outlier in terms of some of the excess that they had, but when you can cut that much from your company and actually grow revenue and profitability,
and
that
raise
says a lot.
prices like
And raise
Salesforce
prices.
did for the first time in many, many years.
Right, and there are a lot of these big tech behemoths that watch that and they're seeing that and they're trying to replicate it.
I also would argue that so many of these companies, they kind of, companies have to spend on what they offer in order to run their business, whether it makes them more efficient, whether it's data analysis, and this is kind of what they need essentially to do their business. So I don't know. I don't know. This group has been on fire.
I like it when you end comments.
That is like do that all the time.
It's a ... scenario.
It's like my conversation with my kids or my husband. I don't know. All right. Anyway, but it's a
Tim,
group
have you
that's
heard
been
of
on fire.
Sorry?
Yeah, see, he hasn't heard.
I didn't hear.
Pong?
Pong.
You mean like the
Oh,
game?
yeah.
Pong?
It's a happy birthday, Pong. 51, did I see?
Yes.
Yeah, it's set 1972 on this date in history. I'm just, I've been walking around the office talking to everybody about this, and
He's
there's definitely
celebrating
an age demographic that knows what I'm talking about, and another age demographic that thinks I'm just
I know what
crazy old
Pong
man.
is. Who didn't hang out in the pizza shop and play Pong?
Yeah, or have it at home on the Atari. We used to play that for
Our
hours.
producer Googled it and looked at it on her screen and was just laughing that this was actually even.
Is there an app for it, I guess?
Yes, there is.
Okay, there it is.
Get it on
Did
Apple.
she say, I don't know? I don't know?
No.
Our producer Matt plays it on his Apple Watch for about 2 minutes, and then he gets bored. So.
All right, Salesforce still up about 4.6% here in the aftermarket. We're seeing
I'm
definitely
bring that Pitfall. You don't remember that game?
That was a good game.
Yeah. See, I like Scarlett.
Frogger.
Who doesn't like Scarlett?
Centipede.
She's like our company gem. All right, guys, that
This is it. The long goodbyes, always with Carol.
I don't know. All right, that's a wrap. On radio, TV, YouTube, and Bloomberg Originals, guys, have a good and safe evening. We will see you tomorrow.
We continue our coverage right here on Bloomberg Television. A deeper dive in just a second into some of the earnings that we just got out of Salesforce, out of Snowflake, and a few others. Stick with us. This is The Close on Bloomberg.
All right, let's return to the latest results out of Salesforce. We did tell you that the company raised its full-year forecast, adjusted EPS, beating analyst estimates. And, of course, its sales also beat analyst estimates for the quarter that ended. Let's bring in Anurag Rana of Bloomberg Intelligence right now. Anurag, as much as sales did beat analyst estimates, this is the third straight quarter where sales have grown 11%. Are investors starting to get impatient here with this? I don't want to say stagnant sales growth, but it certainly hasn't picked up any for the last 3 quarters.
Yeah, and frankly, we don't expect it to pick up till the middle of next year. We are still in a phase where money is being allocated at the expense of some of these software firms into Gen AI, more hardware, more chips, and that's where the things are. But for Salesforce, remember, this company is not in the acquisition strategy anymore. So frankly speaking, 11 to 12% organic growth is not bad in the current environment, with the potential of slight improvement next year.
Yeah, in the release, Anurag, they say they're the number one AI CRM out there. That true?
Well, the CRM space doesn't have a whole lot of AI right now. So, I mean, it's just, you know, I mean, come on, it's a software company.
I was baiting you a little bit.
It's supposed to say things like,
yeah, but I mean, Mark Benioff always wanted to toot his own horn here. But he gets, in all seriousness, though, he does get to an underlying issue, too, about where you can go. If you are a customer, a potential customer or an existing customer to looking to implement these tools, I mean, what options do you really have right now?
Yeah, Romain, if you look at it, in all frankness, Salesforce is the biggest competitor to Microsoft in enterprise applications. There isn't a company as big as Salesforce is. And also in the two major markets it plays in, sales automation and customer service, it has 35–40% market share. So it is really a very big player. So when you see advancements in AI coming in next year, they should have some improvement over there. The real thing for Salesforce is, when do we see a little bit of volume growth going back into that 13 to 15% growth rate? I think that's really the big question for them right now. But having said that, I think the bar was so low today, and as you've seen, they've announced decent results and the stock's up 5%. But again, I think it's going to be a while before we can get to that 15% plus growth rate once again.
If that's the case, can a company like Salesforce attract the talent it needs to get back to that rate of growth? And I bring that up because we were talking about how when OpenAI was going through its identity crisis and what would happen, Mark Benioff is out there, Romain reminded us, offering jobs to any of those OpenAI engineers after Sam Altman left. Is that something that they would want to go to? I mean, what would it take for Salesforce to be able to attract that kind of talent?
See, Salesforce is a company, it pays well, the stock options are there, the market cap is there. So you've seen what the stock's done. They've found a brand new religion in terms of higher operating margins. So from a free cash flow point of view, there are very few companies that are going to grow free cash flow above 20% over the next couple of years. And we think Salesforce is one of them. So there is a lot of good things that are happening with Salesforce, despite the 10–12% top line growth that you're seeing right now.
All right, Salesforce shares are higher here in after hours trading. Anurag Rana over at Bloomberg Intelligence helping us break down those earnings. Salesforce, though, only the second best performer here in after hours trading. The number one performer right now is Snowflake. That company giving a product sales outlook for the current quarter that did beat expectations. Brent Thill joining us right now, senior internet analyst over at Jefferies. We spoke to Brent a little bit earlier in the program to get a preview of what we would learn out of those earnings. And Brent, did what you saw just now, was that pretty much in line with what you expected?
Yeah, I mean, I think what you're seeing is resurgence in software. We talked about the backdrop of what's happening in hyperscalers with AWS and Microsoft and the rest of the ecosystem starting to rebuild. The foundation's rebuilding. Now you're seeing the data cloud from Snowflake and even Salesforce. The results were better than expected. The RPO growth at 14, we were at 11. And better margin. So you're seeing a better backdrop of demand. Everyone was worried that, it was going to ice up and we were going to have an early winter and tech spend was going to go south, and we're not seeing that. So many investors weren't positioned for this. And I think many investors are still overweight semis as it relates to the AI play, and software hasn't been as widely owned.
Yeah.
And so we're seeing demand trends come back and we're seeing good results.
Is there an AI story for Snowflake?
Absolutely. So it's more, the AI story for all of software is a 24 event. This is not material to revenue in 23. So this will have a bigger impact in the second half of the next year. A lot of these products aren't even GA. It's all hype, right? You see the commercials with AI all over your channel and all over other news channels. Today, it's a lot of it's hype. The revenue reality is really the second half of 24. Companies are proceeding with caution. They're not throwing AI at everything. You don't want everyone in your company using AI. So it's effectively what I call a small, slow-moving wave, but will be a huge wave and will carry us in 24 and 25. So the Snowflake story for AI is ask your data questions. What were my sales last month? Who's my best customer? How do I compare to my competitors? So when you think about today, Snowflake is used by data scientists. They're used by trained Snowflake users. They're not used by you and I. You should be able to go in and ask Snowflake questions.
Right.
That's not done today. It will with AI over time.
Thank you for explaining that. Brent. I'm curious when it comes to Snowflake, and this is something our Brody Ford, who works for Bloomberg News, points out. It's very sensitive to changes in economic sentiment because it charges customers based on how much they use Snowflake's data optimization products rather than multi-year subscriptions, which you tend to see with a lot of these software companies. Does AI in the second half of next year give Snowflake the opportunity to change its pricing models to something more like a subscription model?
I think they'll stay on usage, but if you kind of carry forward the analogy, if there's one person inside your company doing the analysis on Snow, and now Cindy and accounting and Bill and customer service can use it, and the CEO of the company can use it, then the usage goes higher. Snowflake has the right pricing model, which is software for the last 2 decades is charged per seat, which is crazy. You buy these seats, you may not even use them. Snowflake's model is you use it, you pay for it. It's smart. And so we think with AI, their utilization should go higher because more people can use it. So we don't think the pricing model changes dramatically, but we think it will help a broader adoption in the number of users, and that user number then will help the overall revenue.
All right, Brent, I really appreciate you taking time for us all day long today to help walk us through the earnings picture here. Brent Thill, Senior Internet Analyst over at Jefferies. And before we move on, some breaking news, this involving Discover Financial. Bloomberg had reported a couple of months ago that the company was looking to sell its student loan portfolio. We're now getting confirmation out of the company that they are exploring a sale of their student loans portfolio and that they will stop accepting all new student loan apps as of February 1st of next year. As of a couple of months ago, this was about a $10 billion portfolio, and the general consensus is that the sale of it would free up maybe about $2 to $3 billion in capital for the company. Shares, though, unchanged on the day. Scarlett.
All right. Well, coming up, we're going to take a look at DEI because results for the second annual Black Equity Index are out today, and they measure how companies can advance racial equity in the workplace. We'll get a report card on what's happening right now. We'll recap with Lene Irvin, CEO of Cold Call. This is Bloomberg.
There's a company out there called Coldwell. It was formerly known as the Center for Talent Innovation. It's a think tank that tracks a lot of the diversity and equality initiatives in corporate America, and it has its new rendition of its Black Equity Index. Now, this was started in 2022, and the BEI provides insight into how companies can make their workplaces more equitable to advance Black representation. Joining us now to talk a little bit about those findings is Linnea Irvin, the CEO of Coldwell. And let's get right to it, Linnea. First, talk to us about how many companies you spoke to, and in aggregate, are we actually better off now than when we were maybe, I don't know, a couple of years ago?
It's a pleasure to be with you. We spent time with 43 companies. So we had 43 company respondents in this year's BEI, in this year's index. And, actually, we think that we are better off than we were a few years ago. Now, as far as the origins of this index, it's worth mentioning that the idea was inspired by a large group of diversity, equity, and inclusion executives, mostly in the tech sector, some in financial services as well, who came to us as a research firm and think tank, really committed to driving change and ultimately looking to have a mechanism to track progress towards racial equity and some of the efforts that they were putting forward. Mm-hmm. And I think in the data, we definitely see opportunity. Okay. We do see some progress. One key finding on the representation front, I think that shows that there's still opportunity, still some room to run, is from a senior leadership standpoint.
Well, can I just stop you right there for 1 second? Because I thought this was kind of interesting about the data, kind of how you, and we don't have to get too into the weeds, but when you kind of were going through some of the key measures like accountability and advancement and things like that, some of those scored pretty well. But then I did notice, and I think you were going there, when it comes to the idea of representation, at least as to how it's characterized in the report here, which I assume means the percentage of the workforce in these firms that does actually have some degree of representation of black employees, black executives as well, that was the lowest of them all. How is that progress?
Right. I mean, I think there's still challenges, right? We see it in our data across our studies, challenges with retention, challenges with advancement once talent walks through those corporate doors. And so we see it reflected in the data. Across our sample, only 3% of executives are Black. Only 7% of people managers. Black professionals are overrepresented, far more likely to work in support functions, right, or HR. So the pathway to advancement and career opportunity via revenue generating product engineering roles still seems very narrow. And so we see that reflected in the representation numbers, especially as you move into senior roles.
Yeah, I definitely noticed that as well, especially the part about Black professionals being overrepresented in certain roles like HR. I'm curious, Linnea, the Supreme Court decision banning affirmative action as a consideration, a factor in college admissions, that did not extend to businesses, but I wonder how it's being felt in the corporate world. What have you observed? How have companies responded to this?
Right. I mean, look, companies are definitely very much aware and, thinking about what this means as it relates to Title VII. So as we fielded this survey, nearly 9 in 10 of participating companies were concerned about the Supreme Court's affirmative action decision and the implications on workplace in the future. And so what we're seeing and what we're finding qualitatively with companies is against kind of this shifting landscape, they're really focused on weatherproofing diversity, equity, and inclusion for the future. So we anticipate them continuing focus on things such as debiasing efforts, equity and fairness in talent systems, concepts like allyship and sponsorship, things that universally benefit cultural climate of an organization and improve the quality of workplace for everyone.
These are programs that require attention, though. With the economic cycle turning, are DEI programs seen as more vulnerable to cost-cutting measures? And very quickly here.
No, absolutely. I think the concern is that there will be a retrenchment and a decrease in investment, but we're optimistic because the companies we work with are staying the course and investing that much more.
All right, Linnea, great to catch up with you and really illuminating report. I really encourage everyone to go out there and read it, not just the press release, but really dive deeper into the actual report itself. Linnea Irvin, the CEO over at Quocal. Stick with us. We'll be back in a moment with an outlook for the markets in 2024. We're going to get that out of Eric Johnson, head of equity derivatives and cross-asset products over at Cantor Fitzgerald. This is The Close on Bloomberg. Let's take a look at how markets performed here on the day. A bit of a rinse and repeat of what we've seen over the past few trading sessions. A mixed day for stocks, fractional losses for the S&P as well as the NASDAQ, though we did see small caps and mid caps post some relatively reasonable gains on the day. But the big story still remains what we're seeing in the Treasury space, a resumption of that bond rally here in the U.S. and quite frankly around the globe, setting up for what could potentially be its best month going back to 2008. As for the rest of the market, a bit of disjointed, though. We did see a resurgence once again in the commodity space, and the VIX remains tamped down around that 13 level. Now, Scarlett?
Yeah, there's a lot of data and information overall for investors to digest today, whether you're in equities or fixed income or across asset classes. So we brought in Abigail Doolittle to give us a recap here. Abigail?
There really was, and a lot of whipsawed action on it. So first up was GDP, the second reading for the third quarter. You can see that it surged up 5.2%. The first reading had been at 4.9%. The survey calling for 5% relative to the first and second quarters, towering above. So that would give room to the Fed hawks to stay higher for longer or to hike. But take a look at the estimate for the fourth quarter. This is what the doves are focusing on, the fact that it's 1.1%. Yesterday, of course, Governor Waller talked about the idea that the economy appears to be slowing down enough to think that we can hold rates steady. But what's interesting, we've had two Fed speakers over the last 2 days with a little bit more of a hawkish tilt. We had Bowman yesterday, Governor Bowman, saying that if inflation were to stick around, that they could hike again. And then, of course, today, Governor Barkin suggesting that hikes could be ahead. That could be a piece of the mixed action because the S&P 500 at the highs up 0.7%. The Russell 2000 2000 had been up more than 1%. The NASDAQ also closing lower. So stocks listening to today's slightly hawkish talk. But to Romaine's point, take a look at this rally for bonds. Bonds rallying in a huge way for a third day in a row. So the bond investors splitting with most of the stock investors. We do, of course, have the Russell 2000 higher, but splitting with the stock investors and taking that more dovish speak with rates coming in on the idea maybe that cuts are ahead even. When we put this all together, B of A, of course, talked about a new forecast for 2024 today, and they're very optimistic. Now, this is a long-term chart. I actually didn't even make it. It's pretty extreme, like one of the ones that I have made in the past. It's not logarithmic. That's why you can really see this massive rally out of the pandemic and, quite frankly, the financial crisis, but 5,000 above on the idea that companies have learned, Romaine, to live with higher rates, adapting, and U.S. exceptionalism.
All right. Well, it's still a good chart, Abigail, even though you didn't make it. Abigail, of course, makes the best charts. They don't call her the chartress for nothing. Let's keep the conversation going here and push ahead to what folks are looking at for the market in 2024. Eric Johnson, he's the head of equity derivatives and cross-asset products over at Cantor Fitzgerald. He has a 2024 year-end price target on the S&P 500 of 4,400. I don't think you need to do the math there, Eric, to know that that's lower than where we are today. Why?
So I think we're actually going to move materially lower first in the first 6 to 9 months of 2024, where I think we go to the mid to high 3,000s and then rally towards the end of the year to 4,400 as the market starts to price in the fact that we have then gone through the cleansing of the economy. Mm-hmm. Our view is that the economy is going to continue to slow and materially slow in the first half of 2024, and that earnings estimates right now are going to follow suit, where they're just too high right now. The market's pricing in 12% earnings growth for 2024, and we're looking for 2% earnings growth because inflation is coming down. Earnings are highly correlated to inflation, a slowing economy, and margins that are at peak right now.
I mean, I'd be remiss in not pointing out that, I mean, around this time a year ago, certainly at the start of 2023, people were relatively pessimistic about what market returns were going to look like, and we got a very pleasant surprise for equity investors and for investors in other assets here. Have you accounted for the potential that there could be maybe, I guess, well, I don't know what the opposite of a black swan is, a white swan or something, that maybe actually means that things might actually be better than feared?
So one of the things we got in 2023 was a multiple re-rating higher. So 2023 earnings were actually approximately unchanged versus 2022. It's just that the market took the multiple much higher. And so if you think about going into 24, can something like that happen again? We're trading at extraordinarily rich multiples. Right now, we're at about 20.5 times 2023 numbers. If you look back the last 30, 40 years, there's only been 3 times where the multiple's been higher than that 21 times. And that was post-COVID, when estimates had just fallen 25%, the internet bubble, and then 1990, when estimates had also fallen 25%. So the market was putting a peak multiple on trough earnings. We're certainly not in those 2 cases where earnings have fallen 25%. So the question is from here is, are we going into another bubble? And while anything is possible, that seems highly unlikely based on the current environment now versus other bubbles historically. So we don't think that's going to happen. And I think from an economic standpoint, the risks are extraordinarily high. There is a delayed impact from rate hikes, and some people kind of brush it off. But if you look at the last 3 rate hike cycles, the recession didn't start for between 10 and 17 months after the last rate hike. Our last rate hike was in July, and it's been a matter of just 4 or 5 months so far. So we're by no means out of the woods, and the market is pricing in that we are.
Okay, so you're saying that we'll continue to see this kind of soft landing scenario through the first half of next year, and because the lack of clarity on what happens with the economy is, and the earnings slowdown is what's going to drive equities lower, the S&P 500 to 3,900?
Yes, I think there's a chance I think we're going to potentially go into recession or get very close to it in the first 6 to 9 months of the year.
So wouldn't that bring the Fed in to cut rates, Eric?
So it would, but the last number of times where the Fed has cut rates, when it's fighting a weak economy, the market has sold off through that, and then eventually, later bounces. But in the beginning, the rate cuts are not a savior because they're cutting rates because things are quite bad out there. And so ultimately, I think that is something that could help towards the back half of the year. But initially, this market, when you go into recessions or you go into very weak economic times, not only do earnings get hit, but multiples also get hit with them. And when you're trading at, again, 20 times right now, you do have a lot of room for the air to come out of the multiple and air to come out of earnings.
Well, speaking
and
of
I think that's what's going to happen.
Speaking of air to come out of multiples and earnings, where does that leave big tech? Because this market is so dependent on 7 big stocks. Even if earnings slowed down quite a bit, all you need is for NVIDIA and Apple to hold on, and that's going to keep the index, the S&P 500, pretty stable.
So I think that's a great question and great point. I think that our view is that the trends that we've been seeing of the big 7 outperforming and really leading this index is going to continue until we go into the weak economic times that I'm speaking about. And at that point, I think you want to pivot and then own cyclicals and small cap. But until then, I do think the big 7 are going to continue to outperform. Now, when I say outperform, in a down market, that means going down less. And I think that they will be, their impact from the weak economic growth is going to be less than the rest of the market, though I firmly believe they are going to feel it. But they can offset some of it from the secular tailwinds that they clearly have that are very powerful.
Eric, really appreciate your joining us today. Eric Johnson, Head of Equity Derivatives and Cross-Asset Products at Cantor Fitzgerald, with a call for the S&P 500 to end 2024 at 4,400. Of course, we're also watching major moves in the bond market as traders price in a Fed rate cut as early as May. Let's bring in now Bloomberg's Ed Harrison, who's been writing about the rally in bonds. And Ed, I love how you phrase it. Bonds have rallied in November. They're still rallying, but you say they're now rallying for more sinister reasons. The narrative is shifting, isn't it?
It is, and I'll use the term sinister because before, when they were rallying, you saw equities rally, and particularly you would see high beta stuff rally, and that includes, high yield bonds. But recently, we're seeing the 2-year lead the rally in bonds, and that's a sign of weakness, and that is that we're seeing more bets for more rate cuts in 2024, rate cuts that are commensurate with recession. That's the only thing that you could understand from the kind of bets that we're seeing.
So we're talking about a steepening of the curve that is more about what? Bet on weaker economic conditions? Is that the general idea?
Exactly.
So unpack that for me, because this gets now to the idea as to, I guess, who's going to be right and who's wrong. But more importantly, this is a pretty crowded trade at this point. And anytime you get to those types of crowded trades, if one thing goes, say a white swan appears, then all of a sudden you almost get the opposite effect where everybody ends up getting flushed out and it ends up being bad for the market as a whole.
Right, and I think it's interesting, if I were to say that we're getting to a point, I would say it's probably on the long end of the curve where it's starting to get murky. You're at 425, Fed funds rate is between 525 and 550. That's 100 and some basis points of differential that you're giving up by going to the long end of the curve. That's a lot of give up. So I think, if there's
with a lot of reinvestment risk, and when you could have locked in just last week at 4 or 5, when inflation, if you believe we're in a disinflationary environment, that's a pretty good deal.
And I think that's why people are getting into that, is because of the fact that they missed that move. But this move is so pronounced. If there's any level where things will fall off, it would probably be at the long end of the curve. And we should probably look to see what the Fed says in its summary of economic projections to see whether or not that has any impact December 12th and 13th. That's when we're going to see a potential impact, I think, on the long end.
Is the Fed still trading stocks and bonds? or did they resolve that?
No. Let's not go there right now.
That's a 13F I'd like to see.
Yeah, exactly. So, Ed, what happens to risk appetite in the meantime while we wait to see how the economy plays out in 2024. I mean, you've got credit, you've got equities, you've got fixed income, and fixed income treasuries are so volatile these days. They're like, and we joke around about this quite a bit, but they're like meme stocks.
There's so much volatility. I think that when we talk about the recessionary risk, it's only starting to become a part of the bond story. So it's not a part of the equity story. And what we've seen in the last 40 years is that equities have been able to rally right up into any recession that we have. So until you see the whites of the eyes of the recession, basically there's no reason to think that risk will sell off. We'll see it first in bonds. We're starting to see it there, but it's not to the point where it's definitely going to affect equities or any other risk assets per se.
All right, Ed, we're going to have to leave it there. We made it through this whole conversation. You didn't even mention Bill Ackman. and how he's doing. But we got to get you back on and find out whether he's going to be the villain or the hero. Ed Harrison, who writes a great column for us here at Bloomberg, someone to keep an eye on anytime you log on to the terminal or to our website. Coming up here after the break, focus on record sales overall. Well, out there in terms of Black Friday, but there's rise in credit card usage and a need for extreme discounts that may actually be showing some cracks in the consumer. Kayla Braun going to be joining us after the break. This is Bloomberg. Well, the Federal Reserve says that consumers are pulling back on spending. That's according to the anecdotal reports in the Beige Book survey, which was released today. Bloomberg also took a closer look at what's going on and found some cracks as well. That data shows that sales were down for Black Friday, on average 4% for a group of 40 companies that rely on Black Friday sales more than their peers. That includes Best Buy, that includes Gap, as well as a few others. Let's try to break all this down and find out, well, just how healthy is the consumer? Morning Consult senior economist Kayla Braun joining us right now to talk a little bit more about this. And Kayla, this is getting confusing because Adobe says, I don't know, sales were through the roof. There are other services out there also said sales were up significant percentage from the previous year. But then you have Bloomberg's second measure data, you have the anecdotal data coming out of the Fed, and you have some other third-party data that seems to suggest maybe we're not actually spending as much as we were a year ago.
You're right. It is a confusing picture in some ways. And I think putting it into context on a few different trends helps us piece through it a little bit. We also collect our own data at Morning Consult, which has sort of showed a little bit more of that weakening in retail demand. So how I would summarize it overall with Black Friday is, I know we've seen reports that there was very high foot traffic, but a similar thing happened last year, even amid that very high inflation, where yes, there was a lot of foot traffic, but spending was actually not necessarily as high.
Yeah.
So people might be going out and buying, but what really seems to be motivating them is deals, which is something that we've seen pretty frequently throughout this period of high inflation recently. When there's big sales, that will get consumers out there to spend. But then if you think about it, it's big sales, it's a little cheaper. So it's not necessarily spending larger amounts, just maybe spending more, all at once.
Well, one data point that does seem to be consistent across the various providers, including here at Bloomberg, is the amount of folks who are relying on credit for these purchases, whether it's credit cards or buy now, pay later, et cetera, et cetera. And I remember earlier this year, we were looking at kind of that uptick in credit card balances. And everyone said, oh, don't worry, when you ratio it out, it's not any worse than what it was in the past. I don't know if that's still true.
So overall, if you look back historically, credit utilization levels don't look that high. And if you look at, other measures like the financial obligations ratio, the Fed tracks it through Q2. We have our own measure at Morning Consult that's monthly. That basically looks at your monthly debt payments as a share of your monthly income. Those measures also are not really flashing warning signs. But what we have seen is that recently, over the past 6 months or so, there definitely has been an uptick, particularly in credit card debt. Looking at some of our surveys, buy now, pay later is another thing that year over year we've seen a big jump, especially among certain groups like parents and actually high income adults. So there's a little bit more diversification in the types of debt that consumers are using. And the concern with that is that even if these levels of utilization don't necessarily look that scary, looking over a long time period, where they stand historically, the interest rates on them have also jumped up a lot. So the cost of carrying that debt is really getting more expensive too. So those two things together, rising debt utilization along with higher cost of carrying balances, kind of combines to make it a little bit more worrisome.
Yeah, it's definitely a double whammy. But I want to go to the BNPL, the buy now, pay later trend that we're seeing. We haven't really gone through a cycle where the economy's turned a lot and buy now, pay later was as prevalent as it is now. Have you done any work in terms of projecting out what that would look like, the fallout from people struggling to pay back their buy now, pay later loans?
So just from looking at the groups that are using these loans more, that's sort of where I see some of the risk. For one thing, we do sometimes splice out our data by sort of a demographic of debt holders. So if you look at, for example, student loan holders, is that group more or less likely than adults overall to be using buy now, pay later? And what we've really seen is that across, if you're a holder of one debt type, you tend to be a holder of multiple debt types. So that just sort of gives a picture of sort of this extra risk for some of these groups. And I worry a little looking at this at groups like Gen Z, who for them, the addition of student loan repayments, that's kind of, you know, not all of them have them, but many of them do. And it's something that they haven't really experienced the last few years. So these sort of changes in the financial picture for certain groups is really where we're starting to see these pockets of risk.
Yeah, well said. You had mentioned earlier that there's a lot of foot traffic, and of course, people are motivated by deals. So if there's something that's 50% off, they're buying now, and those tend to come at the beginning of the holiday shopping season. And we can expect that as long as retailers offer deals, people will be spending. How much does that pull forward the spending from 2024? How much does it leave us in a bit of a hole in the early parts of 2024 with all the spending coming on now, especially with projections that the economy is going to slow, the job market's going to slow in 2024?
Well, I think we're definitely starting to see it with the decline in the savings rate, which has been coming down again. It was rising up earlier this summer, but then it's been coming down recently as consumers have continued to spend. One thing we've noticed in our data is sort of the way consumers are allocating their spending. We've seen more sort of buoyant purchases of travel looking forward to the holiday season. So in the next few months, it looks like a little bit more of those budgets might have been used up for experiences like travel, recreation, rather than on retail goods. And especially after the holidays, I would expect that to continue. There's this general reprioritization of what consumers want to spend on.
Yeah.
And if they didn't buy it on Black Friday when they had those deals, you know, there's still a pretty high level of price sensitivity. So it's hard to see a big rebound in demand for goods following the holiday season.
Yeah, well, except maybe on wellness programs. Kayla Brune, thank you so much. Morning Consult senior economist Kayla Brune on the state of the consumer. Now, still ahead, what investors need to watch for tomorrow. Tomorrow's Thursday, of course, and we will get you up to speed. This is The Close on Bloomberg.
A busy day in markets here on this Wednesday. Could potentially be busier on Thursday. That includes some big economic data here in the U.S.
Starting with PCE at 8:30 a.m. This is for the month of October, and this is the Fed's favorite measure,
Yes.
the favored measure of looking at inflation. And of course, with GDP in the third quarter coming in much hotter than expected, what does that mean for prices?
Yeah, and did you look at the estimates? I mean, you're basically talking about a drop in personal spending,
Yeah.
drop in personal income, and guess what? The inflation, that core deflator, not actually dropping.
So it'll be interesting to see how the bond market reacts to that one.
We're still waiting for this OPEC Plus meeting, which I think was supposed to be, a week ago? But
Yeah, it was
apparently now
delayed.
it's scheduled for tomorrow, November 30th.
Right.
Right?
And it's not in person, by the way.
Yeah, they got to do it by Zoom because I guess, I don't know, maybe everyone's travel plans got messed up.
Yeah,
but
well,
they
it's
clearly
just
can't
delayed.
agree. And we should, at this point, this is basically just all Saudi Arabia kind of dictating what goes on there. Also, well, kind of the flip side of what I guess all of those oil heads are going to talk about. We have COP28 beginning over there in Dubai.
President Biden not attending this.
No, he's going to send Kamala Harris, though, but kind of telling that the U.S. president isn't going to be there. And then one of the big events tomorrow, Scarlett, I know you're excited for this. The Cybertruck finally set to be unveiled.
I did not realize this, but this is a stainless steel vehicle, and you can't paint it. It comes in wraps.
Yes.
You know, these strange vinyl wraps and paint films, I guess.
Yes, that's exactly what it is. And the funny thing is, we still don't know a lot about the truck. They haven't released specs, and we don't actually know what the price is going to be. So it'll be interesting to see what they say.
They look like
tomorrow.
Lego cars.
Yeah, we get some earnings tomorrow too, Scarlett. Kroger, Dell, Ulta Beauty.
Ulta Beauty, I'm really curious about because that's a big gauge on consumer spending for smaller price items.
All right, a lot to parse tomorrow. We really hope that you join us tomorrow. Scarlett and Katie will be here tomorrow, but stick around for tonight. Balance of Power is coming up next. This is Bloomberg.